Good afternoon and welcome to our Smart Regulation Roundtable. My name is Trish Fauché and I'm president of the Institute for Financial Markets, or as we call it, the IFM. Founded 29 years ago, the IFM is a nonpartisan nonprofit educational foundation, and our mission is to educate people about the markets and to increase the public awareness and importance about financial markets and the financial service industry to the global economy. Today's Smart Financial Regulation Roundtable is jointly hosted with our partners at the Mercatus Center at George Mason University. As you know, there's been a lot of talk and growing interest in the news about cryptocurrency. The potential return from investing in Bitcoin has attracted interest among ordinary citizens as well as institutional investors. We're also witnessing hundreds of technology startups issuing new cryptocurrencies as a way to kickstart their funding for their business plans. At the same time, many seasoned market observers have voiced concerns and compared the crypto phenomena to the tulip bulb mania in the year 1637. Financial market regulators such as the SEC and the CFTC have issued numerous warnings about the unregulated nature of the market and the lack of protection from fraud and abuse. Importantly, there's a wide range of questions and benefits about the benefits, the safety, and the regulatory oversight that might be needed in this developing market. Thousands of investors have opened up crypto accounts, and enterprising college students are mining Bitcoin in their dorm rooms, taking advantage of the free electricity provided by the universities. While to date, the SEC has not allowed anyone to offer ETFs based on cryptocurrency, the CFTC has permitted futures on Bitcoin, and today we have at least 4 exchanges that are offering Bitcoin-related products. Social media platforms and financial markets are abuzz about crypto assets. However, what lies ahead is a range of questions about how we foster innovation in this market in a way that's safe for investors, markets, and the economy in general. For our panel discussions, we have experts who will explain how this market has developed so far and what's likely to take shape in terms of market users and regulatory structure. Those discussions will be followed by a fireside chat with Rostam Behnam, a commissioner at the CFTC, which is the regulatory agency that oversees the designated contract markets of futures, options on futures and swaps, and clear derivatives. We also invite you to join in this conversation by submitting your questions via Slido. Slido is a mobile application which lets us crowdsource some of the best questions from the audience. On your tables, you'll find instructions for Wi-Fi access as well as how you can submit your questions to our panel. Just some quick housekeeping notes. We'll have a refreshment break between panel 1 and 2, and then be sure to stay for our networking reception in the lobby after our fireside chat. With that, I'm going to turn the program over to Brian Knight, who is Director of the Program on Financial Regulation and a Senior Fellow at the Mercatus Center. Brian?
Thank you, Trish. Well, look, I'm going to be honest, I don't have much to follow on that. I think that was very ably said, except to just reiterate our thanks that you are joining us to engage in what is hopefully an entertaining and informative discussion of the regulation of crypto assets, both as they are currently being used and regulated and where they might go in the future. And so, without further ado, I'll move us to our first panel. Our first panel, which is going to discuss sort of the current state of play, is moderated by Professor J.W. Verrett and features Paul Atkins, Sarah Hanks, Professor Christopher Brummer, and Joseph Brady of the National Association of State Securities Administrators. Did I get that right? Close. Or NASA, but not the spaceship NASA. Anyway, with that, I will leave it to the first panel.
Thank you, Brian, and thank you for stealing my NASA joke.
I'm sure I've never heard it.
I know,
before.
it wasn't Liam Pickett. Yeah, that's right. Thank you, Sarah. Sarah. I'm very pleased to be joining you and thank the Mercatus Center and the Institute for Financial Markets for sponsoring this event. This is a terrific chance to talk about the state of play in cryptocurrency, what's going on in the market, and what's going on in the regulatory environment. Cryptocurrencies, what are they? I don't really, I'm certainly not an expert in the area, but I've had the experience of trying to explain to my parents what it is. And it was kind of an awkward conversation, right? What is cryptocurrency? Well, it's sort of a commodity in a way. It's sort of a utility, in a sense, kind of like a consumer product. You can be prepaying for services in an ICO. It's sort of like a security. It's sort of like a payment system. And really, it could be all of those things. In some sense, it's kind of like an M.C. Escher painting. Is it a bunny or is it a duck? It sort of all depends on how you look at it, which is a fun academic exercise, but that rubber meets the road when you talk about how this thriving environment is going to be regulated. And you consider the different perspectives of the different regulatory agencies involved here. There's a discussion to be had on a horizontal level between federal regulatory agencies. And I'm pleased to have Paul Atkins, former commissioner of the SEC, here to join us to provide his insights in that area. I think it's fair to say that different federal agencies with interest in this area take different views. I think if you probably ask FinCEN at Treasury, they probably prefer that cryptocurrency go away altogether. I think the SEC is struggling with laws that were passed 75, 80 years ago that weren't designed for this environment, and legal interpretations like the so-called Howey Test that really didn't anticipate a thing like an ICO. At the CFTC, it's been interesting to see Chairman Giancarlo. It seems to be kind of a hit among the ICO Twitter crowd, where he's kind of called the godfather of ICOs. Check out his Twitter profile, and he's become quite popular in the ICO space. And of course, there are discussions on a vertical level between the states and the federal government, particularly with respect to ICOs. I'm pleased that Joe Brady's here from the other NASA to tell us about the perspective of state regulators. Pleased to hear from my friend Chris Brummer, a professor at Georgetown and previously spent some time at the Securities and Exchange Commission in the Office of International Affairs to give us some perspective on some theory about how dilemmas faced in other regulatory environments like banking can inform us going forward. And pleased that Sarah Hanks joins us from CrowdCheck to tell us about what's going on the ground. She interacts with this market in a very direct way, and tell us about not only challenges of talking to innovators and maybe creative innovators in ICOs, with not only creative with respect to products, but creative with respect to approaches to regulation. I'm looking forward to a great discussion, great debate. Let's open with a few thoughts from each of our panelists, then we'll have a second round of interactive discussion, and then we'll close with some questions from the audience. So be thinking about good questions to ask through our process. Paul,
Yep.
the floor is yours.
Well, thanks, JW. It's a pleasure to be here and great to see everybody out today. So, like JW said, this phenomenon or a new technological innovation has really taken the country and the world by storm. And it's pretty interesting. Almost every place you go to, any type of conference or whatever, whether here or in Europe or Asia, if it's talking about cryptocurrency or fintech, you get a standing room only crowd, which is very good, and I think people are very interested in it, and it raises a lot of very basic questions, which gives JW and Chris and your students a lot of things to chew over for your final exams and all that. So that's very exciting. And like JW said, it kind of raises a lot of the fundamental issues that, at least in the securities world and also in the commodities world, people have been thinking about in other contexts now for a long time. And I think a lot of the very basic principles still apply, and it's just now to apply them into a new context. So let's just start, like JW was saying. I think as you discussed with your parents, there are basically, like gall, crypto assets fall into three parts. You have, first of all, cryptocurrencies, which are not securities at all. This is like Bitcoin or Ethereum, although there's some arguments by different folks. But I think pretty much most people have conceded that cryptocurrencies as cryptocurrencies don't really fit the definition of a security. And so therefore they're not really subject to federal or state securities regulation. And then you have tokenized securities, and I think this is the vast majority. So most or many products of so-called initial coin offerings, which I really do not like that term.
Sorry.
Because it really connotes an initial public offering. And I think a lot of the people who have propagated these types of offerings have hung on that to try to help sell the things that are coming out of these offerings. But anyway, they're digital asset offerings basically, which happens to have been the name applied to seminal SEC release that came out last year. It was a 21A report, which is provision under the Securities Exchange Act of 1934 that allows the SEC to do a report in the enforcement context rather than coming in with a hammer over people's heads. So I'll get to that in a minute. And then the third type of assets have different names, but app coins or utility tokens. Although I think also that term utility token, unfortunately, is being abused by people who clearly have a security and they're trying to weasel out of security regulations. So anyway, but I do believe strongly that there are such things as utility tokens, and whether they exist now or not, I believe that at some point we will definitely see those. And so I think as the different regulators have approached this issue, at the beginning, sort of a year or two ago, the CFTC was very belligerent, I would say, sort of coming into it, with a typical swaggering enforcement attitude. That's changed, and as JW said, Chris Giancarlo has now become sort of a darling of many in the commentariat, I'd say, regarding cryptocurrencies, because of the constructive way the CFTC has approached this whole issue. They allowed to go forth in the derivative space, first by the CBOE and then by the CME, 2 products for futures in Bitcoin. And that was, I think, a very wise move by the CFTC, because if you look at the Commodity Exchange Act, if a commodity has a futures aspect to it, if there are futures traded in it, then that gives the CFTC jurisdiction over those things. So there was a double-edged sword there as far as how the CFTC approached it, but I think they were, I think it was good to help institutionalize Bitcoin in the first instance now trading and have those on a supervised platform. The SEC came at it, I thought, initially very well as well. That 21A report that they issued last summer basically took a classic securities analytical perspective to these initial coin offerings, to use that term again, but these digital asset offerings, and basically was warning to people to stop, look, and listen. That there are securities law implications, so watch out. So anyway, so with all that, then after that, Jay Clayton, who's the chairman of the SEC, famously said that he hasn't yet seen a product of a coin offering to be anything but a security. Now he's since backed off and become a little bit less categorical and a little bit more pragmatic, which I think is appropriate. And he used an analogy to tokens that you might buy in a laundromat. He was speaking at a college up in New Jersey last week and had this discussion. But basically, if you're buying, that's a utility token, you put it into the dishwasher or washing machine and off it goes and cleans your clothes. But if you're not basically buying an interest in the laundromat, and that would be a security. But I would say also to build upon that analogy, what if that's the machine dispensing tokens was broken on a particular day, and if you had tokens in your pocket, those tokens then would probably in a secondary market rise because people need to wash their clothes, they can't get tokens out of the machine, so lo and behold, maybe it's worth more to somebody else to wash his close that day than for you to wash your clothes that day. So you then sell your tokens to him at a profit. Now that doesn't make that token a security. It's still a utility token, and it doesn't give you an interest in the laundromat, but that's how that token would increase in value. So I would argue that is what I would expect to see, with respect to tokens going forward. So I don't want to take too much time, but since I see Jerry Brito here, I wanted to give him a shout out. But there have been a lot of applications to the SEC for Bitcoin ETFs. And they've gone through various divisions at the SEC, the Investment Management Division, Trading and Markets, and then also some before Corporation Finance. Nothing's being approved yet. One is on appeal to the Commission over having been rejected last year. But Jerry pointed out that one of the aspects of when the proposal was rejected was that there are not any stable regulated markets for these particular assets. And so we have a catch-22. If the SEC and other regulators, if the SEC doesn't follow the CFTC, in fact, and we'll see what happens with the states, if we don't try to establish regulated markets in the United States, does that mean that things will flee overseas? And so, that's which comes first here, regulated market or the trading. So that's one challenge, I think, for the regulators to look at. There are other issues regarding custody and other things. The market is at work to try to help resolve those. We have tax issues, and we'll probably get into that later on, so I don't want to take up any more of your time. But the SEC, ultimately, I feel strongly, is not and should not be a merit regulator, and so its basic goal should be to figure out how should we bring order to this particular marketplace, because people will buy them. They'll buy them either here or they'll buy them overseas, and the better standard, I think, is to have some sort of a market where people can do so safely.
All right, thank you, Paul. Sarah Hanks, what's going on the front lines?
Okay. Well, I'm really happy to be here as the only one on this platform who actually does this. So we have all of this theoretical stuff about is it or isn't it, and then I am faced with okay, so what do we do about that? So we're working at the coalface, trying to take the entrepreneur's vision and fitting it into corporate law and securities law and making it so that nobody gets sued, hopefully. And so the area that I particularly work in is with what Paul identified as coins or tokens. We don't generally get involved with cryptocurrencies. They're like, that's CFTC, take it away. I am a securities lawyer. I am trying to fit this into the securities law, and I don't need another headache on top of that. Where we are seeing problems that needs to be solved come really from three separate sources. And the first one is the entrepreneurs themselves. I spend a huge amount of time on the phone with somebody who picks up the phone and says, I understand you know about ICOs. I want to do an ICO. And sometimes they really don't know what they're talking about. They just think it's a new way of raising money for early stage companies. And so the first question that we ask is, what are you doing and why do you need distributed ledger technology to do that thing? Because what sometimes happens is some variation of the conversation. I want to do an ICO. Okay, you're a truck company. How are you going to use the blockchain? And conversations become somewhat chaotic after that. The second question we ask is, and what is your coin going to do? Identify the bundle of rights that you want to give to people who are going to invest, and then we will try and fit it into corporate law and securities law. We used to have a sort of internal competition at CrowdCheck for the Internet of Things that should not be on the Internet. The Juicero was our favorite for that one, the juice machine that could call the Internet and get you more squished carrots or something. But we now have a competition for stupid stuff on the blockchain, stuff you really do not need blockchain technology for. where the client's coming in and saying, well, I am going to completely revolutionize skincare. Literally, there is a company that's doing that, and we can't work out how the hell they're using blockchain technology for it. And we're not sure that they can either. And so there is this challenge where you get from the genuine desire that entrepreneurs have to use something new, to create something valuable, and then making it fit in corporate law and securities law. So that's the challenges that we have from the entrepreneurs. And frequently the conversations also go, but what if I? And then if I do, and we're like, no, most of the things that they want to do is, can I get around the securities laws by doing X? And we're like, no, we don't like the word getting around anything. We're trying to fit within the securities laws. The second group of problems that we encounter come from corporate law itself. Because once we know what it is that the company wants to do, and we do hope that it is actually a company and not an unaffiliated bunch of people who are going to be individually liable for each other's actions under the securities laws. So once we know what the company wants to do, we try and work it into some form of corporate structure. It's much easier to take a not very well-defined group of bundle of rights and fit it into an LLC, which is a creature of contract, than it is to try and fit it into a traditional corporation. So sometimes what we find is what we are trying to fit this into corporate law, like, okay, so you've got some elements of equity here, so we think we're going to have to make that to be a preferred share, and then some elements of other stuff which we can maybe put into a token that may turn into a utility token later, and I can get into the changing nature of things that are deemed to be utility tokens later. But we're running into some problems with some of the nitty-gritty of complying with corporate law, like Delaware law. Delaware law, as everybody has been pointing out to us continuously, has been amended so that you can use blockchain technology to record transfers, which is great. But it still says that you have to have a share register which has the names and addresses of your shareholders. Now, if you don't know the names and addresses of your shareholders, or if you don't know whether address means actual physical address that snail mail goes to, or will an address, a wallet on a blockchain act as an address, we don't know the answer to that one. So we're going into the SEC with filings that say, in effect, we may be violating Delaware law, we're not sure what to do about it, and put it in as a risk factor. Which takes us to the next group of source of problems, which is securities law itself. Once you've decided these things are securities, you've got to fit it within an available exemption from registration. And I say exemption from registration because we do not advise any of our clients to try registering these things. None of these outfits are ready for quarterly reporting and proxy filings and all of those things. So they have to fit into either Regulation A, Regulation D, Regulation S, or Regulation CF, crowdfunding for very small deals. Those are not so difficult. We know that the rules there, as they apply, require us to give good descriptions of the security, which also includes the terms of the utility token that might be issued later. That we have no problem with getting through SEC requirements. It's secondary trading that's really causing us the problems here. Things like Section 12G, the rule that says when you have a certain number of shareholders, holders of record, you now have to file with the SEC. What's a holder of record? Is it wallet? I mean, that's what we're doing at the moment. We're saying we'll count one wallet as one holder because that's the only thing we have. And that would be an area where a blockchain, a sandbox for blockchain issues would be very, very useful because we think we're doing with the best we can, but we do not know if we're complying. And then other things, the secondary trading, the fact that once any of these exemptions, an offering that was initially using one of those exemptions, goes onto the blockchain, secondary trading is not preempted from state securities laws. So we need some kind of guidance with respect to what's happening at the states. If there is trading on a blockchain and it goes from Texas to Florida, and is there an exemption under Florida law? And do you even know that you've got somebody in Florida? No, you don't, because it's an anonymous address on a blockchain. So those are the three sources of our problems. And the one thing I just wanted to throw in there in response to what Paul was saying is we do see, with respect to utility tokens, we see an evolution. There is certainly a point at which the security, when it's issued, the token, the rights, you have a right to do, well, we're not quite sure, but we're going to build a blockchain, and we think it will let you monetize squirrels and keep records of where the squirrels go. And you'll be able to, well, we don't know, we'll make it up as we go along. So you don't know what it does, you don't know the mechanism upon which it does that thing, like the blockchain, and you don't know how many squirrel movements you're going to be able to record. And the ecosystem is being built with the proceeds of the sale of that security. That is a security. But when it's all built, and you've got your squirrel monitoring token, and you can monitor squirrels, and you will know exactly how many squirrels you can monitor on that block token, I think it becomes completely the laundry token. So there is this movement over time, and that's something that we have to fit into the securities laws, which is kind of a challenge. But it's a fun one.
Very good.
Only
Professor-
because there was a mention of the state securities regulators. I didn't know if...
No, Professor Brummer, we'll go
Okay.
back to a little theory, and then we'll close
Right.
it out with the states.
Well, as I get, as I'm sure everybody else on stage, we get quite a few phone calls almost every day from either other regulators here, abroad, or other entrepreneurs and folks at other law firms who are trying to think through many of these questions. And I think that if I was going to try to tie together both Paul and Sarah's comments were a number of things. Number one, the challenge of the stuff, of regulating innovation, is not necessarily new, but there is a question as to how new is and are virtual currencies. From a definitional standpoint, you're thinking about the digital representation of value, where transferable units are relying on a distributed ledger technology. And new technologies create interesting opportunities for entrepreneurs, and they create new kinds of headaches for regulators. I think that Sarah's original sort of cast of problems that she identified weren't necessarily regulatory problems. These are business problems, which is when entrepreneurs are trying to identify what this technology is, and you're asking what the value proposition of that technology or what your approach is going to be, that's a business question. If you're trying to figure out why is it that you want to apply blockchain technology to what the entrepreneur wants to do, that's not just a question as to whether or not you have a token or a tokenized security, or whether or not you have a utility coin, or whether or not you're dealing with a native coin or a currency, qua currency. You're talking about, do you know what you're doing as a business person? Now, assuming for the moment that the entrepreneurs have some comfort and knowledge in what they're doing, whatever they're doing is operating, and I think that's useful to remember in some kind or against some kind of regulatory backdrop. There are different regimes. Sometimes they're overlapping, where you can operate in the world of the securities law world, or alternatively, you can be operating in the commodities law world. Even certainly where you're operating with a utility token, it could probably be defined under the very capacious CEA as a commodity. The question then arises as to what authority or how deep is the authority of the CFTC to act, and that in and of itself is tied to certain powers that the CFTC enjoys in terms of its anti-manipulation and anti-fraud powers. But the whole point I'm trying to say from a sort of 10,000-foot level is that no matter where or what kind of coin or transaction that you're using, 9 times out of 10 there's going to be some kind of regulatory ecosystem. And the question is, how adequately prepared is that ecosystem? And I think what Paul identified is that even if you're looking at the security, at the financial product itself, that supporting cast of characters isn't necessarily is potentially not up to snuff to deal with this innovation, right? So that adds on yet another problem, which is, okay, do the business people know what they're doing? Do the regulators have a plan that can fit and anticipate this new financial innovation? And then thirdly, regulators don't act in a vacuum. That in and of itself, they rely on certain kinds of financial intermediaries as gatekeepers, as providers of quality control. And I think that when you're both on the CFTC side and on the SEC side, there's well, it's moving at different paces, but there's a consideration as to how robust that larger ecosystem is. I don't want to use up too much time because I think that there are a million issues that we can get into. And so if I do go a little bit over, I want to reserve that balance. But I did want to also make one quick note. The questions that regulators here in town or the legislators are trying to think through when it comes to cryptocurrencies, this is not just an American problem. There is certainly an interest and a need from both the standpoint of financial innovation, but also market integrity to figure out these questions. But it's useful to know that our friends on the other side of the pond aren't necessarily any better equipped or situated currently to deal with them. When you look at what's happening in the European Union, there are very divergent approaches. Indeed, at the federal level, some of the key actors are trying to think through internally what authority they have to intervene in these markets. And just as there are, which we'll get into in just a second, some discrepancies between each of the 50 states and certainly real obstacles, whether or not it be not just securities law, but also money transmitter laws. When you look at the European Union on a member state level, there are some serious disagreements in terms of how to engage virtual currencies. And I would say just early on, if you're looking to leave the United States and flee to Europe in particular in search of regulatory certainty, I would advise you to take a breath.
All right. Joe Brady, the last word on the first round goes to Mr. Brady from the North American Securities Administrators Association, North American, so Canada too. You can tell us what's going on in the provinces at the state level. I imagine states have different approaches. New York, Arizona probably have different views. Tell us what's going on there.
Well, so thank you very much for inviting me to be on the panel today. And yes, our members at NASA, NASAA, we've been around since 1919, so we claim it first. Yeah, so that's correct. Our membership does include the provincial and territorial securities regulators in Canada, the 53 U.S. jurisdictions, and the CNBV of Mexico is also the national regulator, banking and securities regulator of Mexico is our member as well. We have enough to worry about with securities. I don't do money transmitters, so we have our hands full. So I'll leave the money transmitter issues to the folks more equipped to deal with that. And unfortunately, Sarah, I don't have any answers for you as it relates to exemptions for secondary offerings in the states. Something we're certainly looking at and thinking about. So at NASA, I just wanted to spend a minute talking about how we're thinking about how our members are approaching this issue. And one of the things we won't talk a lot probably about on this panel, other than the short little talk I'm going to give about it, is the piece that we've been focused on relative to retail investors and investor education. So our members, certainly from the context of being able to regulate broker-dealers, investment advisors, as well as issuers, one of the things that we do and spend a lot of time on is investor education, because we do have a broad reach throughout the country. We have offices in every state. Most of our members either are or work for statewide elected officials. So I wanted just to talk a second about how important that aspect of it is when we have these new and emerging technologies that catch on. We have Main Street investors looking at trying to jump in on this and make money. Our members often think about the investor education side as well. So we've been very focused in that space, and I'll move to enforcement in just a minute, but I did want to talk about that. We also have, we have a working group, internal working group, and we've been engaging with various academics, representatives from the industry, other regulators, in this give and take of ideas. And later in May, we're hosting a FinTech forum, not unlike this one as well, a full-day forum where we're going to be talking about regulatory issues as well as the experiences of our members and trying to get their hands around these issues. So I'm now going to talk a little bit about the enforcement aspect of this. And I want to say that I'm not trying to lump all of the folks who are trying to put together these deals, who are coming up with these new and innovative technologies and looking at ways to fund them. The folks who come into Sarah's office are probably not the people I'm going to be talking about for the next little bit right now. And so I just want to make that crystal clear that we understand that there are folks who are trying to launch new businesses and launch new innovation and technologies. And the information I'm about to talk about is not necessarily relevant to them. But while we're all sitting here thinking about these complex regulatory issues, there is significant fraud going on in the cryptocurrency and ICO space. That shouldn't come as a shock to anyone, I'm sure, who's listened to the Chairman Clayton, as Commissioner Atkins pointed out, and who's also paid any attention to the information that we've been pushing out as well, and more to come in that space. And I'm going to highlight particularly the efforts of one of our members, Texas, but yes, our members across North America are focused on this issue, Canada as well. Our members are primarily civil law enforcement agencies. They use, for the most part, civil remedies, primarily administrative cease and desist orders. So that's where the initial hit is going to be. But I wouldn't be surprised as these cases work their way through the system if we don't see criminal referrals and criminal prosecutions for some of the activity that's going on in this space. And for all of those out there who are working to do the right thing and being diligent in this, I think this is where we all sort of link arms and we're trying to work together to keep the bad actors out of the industry, because they will, in the long run, harm the folks who are trying to do good. So I think it's really important that, and right for our focus to be on enforcement as we all struggle and work through the regulatory issues as well. But let me just spend a minute talking about some of the enforcement work that Texas has been doing in this space. And if you're interested, they actually just published, I believe it was yesterday or earlier today, a summary of some recent enforcement actions and some of the interesting sort of takeaways from that space. So beginning in mid-December or so, the Texas State Securities Board began really focusing on social media and particularly cryptocurrencies. And in that 4-week period, beginning in mid-December, they opened 32 investigations. So that's not a small amount of number, 32 investigations in 4 weeks. Dating back to September, the beginning of their fiscal year to date, they've opened 50 investigations. They've issued 6 administrative orders, and they've settled one case with a gentleman who didn't quite understand what he was doing, but when they brought it to his attention, came in and began working with him to try to get him compliant. And most of these, interestingly enough, are related to Bitcoin. That's what they're finding. So there's some tie into Bitcoin, not necessarily, legitimate, obviously, but there's a reference to Bitcoin or a tie into Bitcoin. And that's obviously driven by the increase in the price of Bitcoin, as well as, the expanded use and, folks looking to get in on the increases in prices in Bitcoin. One of the findings in the report, which Professor Brummer mentioned in his testimony before the House Financial Services Committee, was that in the white papers related to the ICOs, they found in more than 50% of the cases that there was no reference to a physical address or contact information for the promoters. And I think my favorite, sort of funny but kind of sad, is that there's an affinity for using fictional photographs for various executives at the company. And my favorite so far has been I think it was the Ethics Advisory Committee. It was a picture taken from a GW event with former Solicitors General and Ruth Bader Ginsburg. So yeah, pretty outstanding advisory committee, if you ask me. Another thing, a couple other things I wanted just to mention about it was that something that we've been looking at carefully, which are who's most likely to be victimized by frauds in the space. And we did some polling and testing in this early on, and initially we were finding that it was most likely to be millennials, because those are the folks who are more tuned into this type of technology and use this technology, less concerned necessarily with baby boomers. Unfortunately, that is not necessarily the trend that the regulators in Texas are seeing. They are seeing a significant number of retirees or pre-retirees who have been caught up in these frauds. So that too adds a layer of complexity and concern. But in my conversations with the staff in Texas and reading through their reports, I said, okay, tell me that all hope is not lost here. And they said, yeah, it's not all lost. And as Sarah mentioned, we are seeing the Reg D Rule 506 offerings, people who are willing and working and trying to comply. So, there is some good news here, and we're hopeful that we can sort of keep the focus in that space, work through these regulatory issues, and keep up the pressure in the fraud space to try to get those folks out of there, to tamp down those offerings so that we don't see a lot of victims. I can tell you that you will see more activity in this space from the state regulators in the not too distant future, so stay tuned. The story is ongoing.
Well, we're going to do one more round of thoughts and comments, and questions are coming soon, so get ready. I don't know about you, but on the one hand, I am not ready to invest in an ICO at this point. But on the other hand, I had a somewhat ironic conversation with a Corp Fin senior official over dinner where we're talking about ICOs, and I say, why does it need to be regulated? And they said, because it's unregulated. I said, yeah, but why does it need to be regulated? Because it's unregulated. Yeah, but why does it need? And we would have gone on like that forever, except the waiter came, and so we got out of that recursive loop feedback. Seems like there's lots of fraud there, sure. Just as there was lots of fraud in the initial oil boom that created Texas, the initial gold rush that created California. Something uniquely American about new innovations thriving despite initial fraud in the early Wild West days. I also kind of wonder, and this is a question for everyone, Chairman Clayton has, at the SEC's perspective on this, Chairman Clayton has said, all these ICOs look like securities to me under the Howey Test. To his credit, he's mostly focused enforcement activity on the worst actors, the worst frauds. But I want to sort of think through that idea a little bit. SEC versus Howey is an old test, a very old test, that uses a test that came from the 20s, from blue sky laws. It's old. It's almost 100 years old. An investment of money with the expectation of profit solely from the efforts of others. And then there's tortuous reasoning in later cases that say, well, when we said solely, we didn't really mean solely. We mean like mostly from the efforts of others. So I sort of told him, man, I teach this stuff, and I wouldn't hang my head on SEC versus Howey being this great, wonderful test, because it's terrible. It's terrible. Time to rethink it. Is there any hope we're going to, the agencies will all work together, create an MOU, or we'll get some great new innovating exemption for ICOs that creates something not quite as paternalistic as crowdfunding, but maybe a little bit, or is there no hope at all? First, Paul, what do you think? And also, an opportunity to respond to the other folks on the panel.
Yeah. Well, first of all, I think I agree with you. I think Howey, is good, kind of basic principles being laid out. But I think that it's probably ripe for a re-look, and I think there'll probably be a judge somewhere with the right set of facts where we could be really surprised at what comes out of that. And when you ask about MOUs and can the agencies get together, I have to look at Walt Lucan, who he and I were the respective liaison between our two agencies at the time. And even to get a simple MOU done between, like, these are two agencies of taxpayers, right? And we ought to be working, we have the same boss ultimately. But we had to move mountains, even to have the examination folks kind of work together and even just to schedule things at the same place they were going to visit at the same time and not do things too overlapping. But we have lots of stories about that. So I wouldn't necessarily, each agency has its own culture and proclivities, so I wouldn't really count on that. But we do have, we have a Treasury Department. They're going to be coming out with a report on fintech here in maybe short order. I don't think they're going to be dealing with cryptocurrencies, so that's okay. But at least they might set out the general approach as to fintech, and then maybe that might galvanize, from the Treasury to help herd the cats that way. But there are also other things. I mentioned tax issues that right now our tax code is also rather antiquated, and to the idea of any transaction in cryptocurrency, like if you're buying a Starbucks cup of coffee, and if Starbucks starts taking Bitcoin, that theoretically under the tax laws the way they're written now, you have to recognize when you not only do you get your cup of coffee, but you potentially have a gain or loss on that transaction, even though it's not in dollars, it's in Bitcoin. So that's kind of a crazy situation and a big, of course, impediment to real use of these things as a currency. And then you just have inherent problems with Bitcoin itself as far as the way it's constructed and the amount of time that it takes and energy, literally both physically and mentally, and to verify all these transactions. Whereas a credit card can do thousands of them in a second. With respect to Bitcoin, it literally maybe 3 or 4 or 5 transactions can be done in a second, just because of the nature of a distributed ledger and how long it takes physically for light, to get from one place to another. So all of those impediments are really practical things that innovation, I think, at some point will, benefit everybody, and will, vault over that. But and one other point to Sarah's thing about with the Delaware issues. Back when I was at the SEC in the last decade, we instituted a special, or Delaware basically instituted a special procedure for to get a declaratory judgment from the Delaware Supreme Court if the SEC certifies a question to them, and they promise they'll do it lickety-split. So basic questions like that, if you might, as you're working with the folks in Corp Fin or whatnot, to encourage them to approach the Delaware Supreme Court if they want to take it on, that question might be helpful. So anyway, so I think there is hope in the future, and there are a lot of moving parts here, but I think that this is not something that's going to get deep sixed as a technology. I think there are a lot of benefits to blockchain and others, and that we haven't really even realized yet. So I'm very positive in an outlook.
That's good. Thank you for mentioning that. I have an article about Delaware Certification, the SEC certification of Delaware. Professors are always talking their articles.
Oh yeah, okay, good.
Sarah, I'm sure you have lots to say.
Well, as far as the Delaware issue goes, I think nobody's going to dare do that unless they know what the answer is going to be. Because don't ask the question unless you... and I think the answer is probably going to be the wrong one unless we can reach out to Delaware about how this should happen. So I think don't hold your breath waiting for any of us to ask the SEC to ask Delaware about that. In the meantime, we'll just have a risk factor saying we might be violating something. Come at us, bro. Going to push back on one thing that you said, something uniquely American about securities fraud. Speaking
No,
as
something
a member-
uniquely American about overcoming securities.
Well, I was actually going to take credit for being part of the nation that invented securities fraud. The East India Company, an enterprise of great value, but nobody to know what it is. That's where we're sort of coming from here. And that's sort of where ICOs are at the moment. I mean, one thing that I don't think we've touched on this panel is I saw a number recently that estimated that of all of the ICOs, 86% of them have now gone under. Either have actually failed, or you can't find anybody or do anything with the coin or anything like that. So that's a kind of very large number, and I think it's a large number of dollars at the same time. And I think that maybe we are in, I don't know, we might not be in peak ICO, but we might be peak ICO conference, because there are so many of these things. And so there is something incredibly useful about the whole technology, but I think all of these failures are showing here is where it just doesn't work. And fine, sometimes it doesn't work, so long as you've said, we're producing a technology to measure how many squirrels jump off a tree, and people think, that's really stupid, and don't invest. That's fine. The one thing that I would like to see, though, to build on something that Joe had said, was reaching out, all of the regulators, reaching out to the potential issuers to explain more about what the rules are. So we don't get the situation where you've got the Massachusetts regulators pulling in this guy who had an ICO, the caviar coin, I think that one was. And part of the quote from the transcript is, well, I thought because I set up a Cayman company, I was okay. And he didn't really probably intend anything bad. But there's so much myth out there. We set up a Cayman company. We set up a Belize bank account. We do some thing in Singapore. There's a lot of very young, very innovative people who are believing stuff that they see on the internet. And having the regulators move out there and say, look, come to us, talk to us. Let's talk to you about how these things should be properly done would be worthwhile. Because there's a lot of bad actors there, and there's a lot of people who are just screwing up because they don't know.
They seem to think that the word utility has operative significance in the securities laws, right? When it doesn't, that's not a thing.
Yeah, it's the magic unicorn fairy
Yeah,
dust
right.
thing. Yeah.
Chris?
So you brought up the Howey Test in front. Those are really interesting questions because certainly I do believe that there are important questions to ask about the robustness of our framework as it pertains, as you make the shift from sort of industrial age companies to sort of digital companies. And it's worthwhile asking serious questions about how effective our rules are. That being said, the premise behind securities regulation largely is transparency to help to enable the efficient allocation of capital in our society. And I think that one reason why regulators in particular are asking questions about ICOs is because what was a very or largely expert community has now grown large enough that retail investors are starting to participate. And there are questions as to basic information asymmetries. There are questions as to the awareness, level playing field questions that these retail investors may have when they are operating in this space. And the Howey Test is a very interesting test because, as you know, as a securities law professor, our students will go and they'll memorize all the different prongs to the Howey Test, but they're not actually thinking through all the time what each one of those prongs mean. I mean, there's a reason why you have each one of the prongs in the Howey Test. And just to sort of highlight a couple, a common enterprise, and whether or not there's an expectation of profits to be derived on the efforts of others. These are policy questions in which are embedded questions of informational asymmetries, power imbalances, the ability in and of itself for an investor to be able to get the kind of information to make an informed decision that would allow that efficient allocation of capital in society. And where there is, for lack of a better word, some kind of market failure, that imperils the ability of the investor to make that efficient allocation of capital, there is at least a presumption that there should be some kind of regulatory intervention. And what regulation means can mean a lot of things. It can be a substantive regulation, or it could just be mechanisms to help to enable more transparency. And one of the things that when you look at a white paper as, let's say, a substitute for an S1 or a substitute for a Form 1A, for a Reg A offering or any kind of disclosure is, well, are there certain kinds of, and this is what I mentioned also to Congress a couple of weeks ago, are there certain kinds of things that you would want to know if you are an investor in an ICO? And just as a matter of first order principles, and then to ask whether or not our regulatory apparatus, whether or not you're talking about a full-blown public offering, or whether or not you're asking about a crowd-funded venture, or whether or not you're asking about a Reg D, what are the tools that are available? Are they sufficiently robust to allow an investor to make an informed decision without necessarily getting into a merit-based regulatory regime? And when you ask questions about, well, do I know where the issuer is located? Is the technology, that is being advertised, the value proposition in an ICO is largely based on technology. And that in and of itself creates its own unique kind of information asymmetry where you have, say, someone without a technical background seeking to participate in these markets. So is the issuer making and taking all the steps possible in order to apply a plain language disclosure, not just to, say, a description of the security, but a description of what the value proposition is? Because in a startup that may have a very short history, maybe the value isn't necessarily, as in 1933 and 1934, on the past financial statements and the profits and the earnings of the company, but instead that value proposition lies in what that technology is, the background of the founders, the ability of the founders to actually realize and operationalize the potential behind that technology. Those are the kinds of things that, even if you're not an expert, it would probably profoundly improve the ability to make an informed decision. And I think that those are the kinds of decisions, besides informed decisions to make sure I keep off my cell phone. I think that those are the kinds of questions that ultimately, even when you get into questions of registration and liability and enforcement, those are the kinds of basic questions that securities regulators are going to be forced to really think seriously about. And I think that those are the kinds of questions that when legislators start to think about these questions, because it's not just a regulatory question, they're going to start to think about. I said I was going to go a little bit longer because I did want to add this one extra point. Speaking of papers, I have a paper. The paper is called FinTech and the Innovation Trilemma. And in this paper, I make the argument that when it comes to creating clear rules, achieving market integrity, and fostering financial innovation, usually you can only get two of the three. And to the extent to which you're looking for in the Howey Test a clearer Howey Test, you may get one, but just be careful for what you ask for. Yeah. Because you may get clearer rules, but those clearer rules may come out in a way that, as a libertarian, you may find to be a bit officious. And this is one of those spaces where the trilemma, which always characterizes financial innovation, is exacerbated. And it's exacerbated precisely because it's not just a new technology, but you're having certain kinds of technology and certain kinds of forces at play that even when you go back through history, you haven't really had to deal with. Forces like artificial intelligence, whether or not you're talking about smart contracts. Questions of big data, which then push into other kinds of regulatory concerns from agencies that have not typically been as pronounced in the financial regulatory space when you get to questions like privacy. And those kinds of pressures and forces exacerbate certain potential trade-offs where, when you're trying to create a very clear rules-based system, you may end up with something that from a regulatory standpoint and from other stakeholders, you may end up with something that you just didn't expect. Everyone has to. There is an argument for making sure that you get it as right as you can the first time, with the acknowledgement and the understanding that the underlying technology and the forces behind the discussion about that technology are always evolving.
I wish we could design a reg ICO with just you and I over a cup of coffee, because I think we could find common ground in like an hour.
Brummer coin.
But when you watch, when you
Buy it.
you know, Sarah and Paul, everybody was around for crowdfunding, the initial McHenry crowdfunding bill on the House side, to the Senate's little tinkering with it a little bit, to the full proposal, the final rule. Man, it became a whole different thing. And I fear for the future of ICO regs in the same way. But Joe?
Well, so first of all, let me reassure you that there is still plenty of oil and gas fraud going on today. And while there's perhaps precious metal fraud is not as prevalent as it was a few years back, we'll just wait for the price of gold to spike again, and we'll see another spike in it as well. As someone who used the Howey Test as a regulator, to shut down basically a fraud involving then customer-owned coin-operated telephones. A case that was actually not my case, but one that the SEC ultimately brought involving the same defendants that I had out of Atlanta, that found its way to the U.S. Supreme Court in a 9-0 decision that found that those products were in fact securities, investment contracts and securities. So there's a fondness in my heart for Howey. Should we revisit it? It seems to be working pretty well from my perspective, or at least from my members' perspectives. I shouldn't say that because I don't necessarily speak for. There might be one state securities regulator out there who thinks we should revisit Howey. So I don't. I think that the test. Well, the definition of security is. It's a list of things. It's not, the sort of aspects of what it is. So I think if you're going to revisit Howey and investment contract, then, does that then mean we have to go back and revisit the 33 Act and the 34 Act and the definition of security there? Maybe, maybe not. I don't know. And from the standpoint of cooperation and working together and regulatory challenges that Commissioner Atkins spoke to, we very much do try to work. The state securities regulators collaborate and talk to each other on a regular basis. We engage with our federal regulators, the SEC, and last year signed when Commissioner Pivovár was acting chairman, signed an MOU in an effort to try to establish some sharing of information on new exemptions, so Reg CF and Reg A. So that, again, we could engage in information sharing in an effort to try to make sure that the markets had sort of a good space in which to grow and thrive. So there are efforts, there is work going on in that space, and we do, I think, or have had some significant strides in recent years to do that. So can we do more? Sure. Are there always opportunities to improve? Yes, there are. And then just to touch base on what Sarah said, I think many of our members you will see engaging with folks who call on a regular basis into their offices. I was in Jackson, Mississippi, and saying, I've heard about this thing, or I'm interested in doing this thing. What can you tell me about it? And, there are limitations on what you can and can't say relative to offering legal advice, but you can at least try to put them on a path to get them into where they need to be, or point them to the resources they need. And that's not uncommon amongst our regulators. It's not also uncommon amongst our regulators that people will find themselves the respondents in an enforcement action. That's because they're there to, in part, protect investors. I get that the capital formation mission of the SEC is explicit, not so much in the state blue sky laws. We do it, but our primary focus is going to be on and will be on investor protection, and we'll do that the way that we think. Again, best protects investors, best provides the environment for these new and emerging technologies to grow.
Do we have any questions? All right. Vera is going to be the voice of and the screener for our questions. It can get more exciting when you just let anyone. But well, perhaps Vera can find the best question for us. What do you have?
I'll try. So there's someone wants to know, how can an issuer in a coin or token offering accept cryptocurrency as a payment for a security? What are the best practices for AML KYC?
Oh boy. Okay. Someone asking for legal advice. That sounds good. That's great. I'm not barred in the District of Columbia. I'll pass on the question. Does anybody have anything to offer related to that?
I mean, most of them are, actually, especially in the Reg D space. So most of our Reg D, and that's the offering that's to accredited investors only, most of the offerings that I'm aware of are taking at least Bitcoin and then probably several of the others as well.
Ethereum, right? Isn't that one?
Ethereum, Ripple. I don't know if anyone's taking like more than 5, but certainly the top 3, most of them are taking.
So, I mean, I think embedded in that question, and some of the great folks over at Coin Center have commented on this, and I think Davis Bulk has also had an interesting series of elaborations, is the money transmitter question. And I couldn't tell if that was really the basis of the question, but it certainly sounded like that. And there has been more, debate about some of FinCEN's efforts to clarify its initial 2013 guidance on money transmitter laws. And, great thing about being a professor is usually I can say, well, what do you think? And unfortunately, I don't know who asked the question. But when you think through the facts that seem to have been presented under that question, it's a little bit complicated. And I was actually drafting this out just now earlier to one of my students, but it does sound like that would be someone involved in the business of exchanging cryptocurrencies, which would then trigger a definition or qualifying as an exchange and as such a money transmitter. And so therefore you'd want to think through and look at all of the applicable laws and regulations for money transmitters under the Bank Secrecy Act.
And just to add to that, I mean, it's implicit in the question, and as Sarah was saying, if it's a Reg D offering, you already know who your investors are and who is going to be buying and from whom you are accepting those cryptocurrencies. So presumably you'll already have done your BSA, AML, checks beforehand, and it's not terrorist financing, and or you've at least satisfied yourself on that. So, but I guess the query is kind of looking forward. If people get more comfortable that they can do a wide-ranging offering and have it registered with the SEC and have a real public offering, then I think inherent in all of that is the question of who is investing and from whom are you taking the money. So.
And I think probably this discussion is related to what Paul mentioned about the FinTech Charter and the Treasury FinTech Report and the Comptroller's announcement that he's going to make a decision about FinTech charters within the next 90 days. So it'll be interesting to hear what he has to say about that.
Yeah. Well, and then also so I'm a co-chairman of a thing called the Token Alliance with the Chamber of Digital Commerce, and so we're hoping to come out here in the next few weeks with some guidance for people who want to either do things the right way with respect to a securities offering, or if they want to not have a securities offering, what do they need to do to ensure that they won't get on the wrong side of the law?
Can I just add, speaking of both the FinTech Charter and also this particular issue, and then obviously the money transmitter question, because it sounded like, am I a money transmitter? And sounds like it, but what then are the applicable rules? Do you go to New York and try to establish yourself as a trust? Do you go instead alternatively to get a BitFin license and the like? And I'm only mentioning this because up to this point in time, our conversation has largely been a market regulatory series of observations, right? Whether or not we're in SEC land or whether or not we're in CFTC land. But then when you move further afield, not just into the world of the Treasury, but also then into the world of the banking regulators and where you keep customer accounts and your money, then you get into some very important banking regulatory conversations, and I think all the relevant authorities will have more to say in the near future.
I have a question before we take another one. I've always been a fan of, or at least tried to explore the idea of self-regulation, tried to think about it for the hedge fund space. We lost that fight. Paul started that fight, but
we won it, but then Congress changed the law.
that's right. I'm sorry. We won it, and then we lost to Congress. That's right. The Winklevoss twins have an idea to self-regulate in this sector. Not necessarily asking for comment on their plan, but generally speaking, is there hope for self-regulation in this space? I know the SEC and the CFTC take different approaches to self-regulation. The CFTC is fairly deferential to the NFA. We have these odd creatures overseen by the SEC that are sort of self-regulators, but sort of not, like FINRA. To what extent is that going to be part of the conversation going forward in the regulatory sphere?
Well, I mean, I'm hesitant to say because I'm not really sure what the parameters of that organization would be. And
Maybe your organization could be the self-regulatory.
also maybe. But anyway, we do see all the issues that come up with respect to self-regulatory organizations. Are they state actors or not? Who has to be involved? Who's not? And is it a voluntary organization? Who's going to pay for it? Because they're not cheap things to run. And so all of those things have to be addressed. So anyway, I think that's kind of pushing the rock uphill a bit. But we'll see. I mean, who knows if there's interest in at least the folks who are proponents of that are really actively pushing it, and Godspeed to them if they can build up interest in it.
And can I just add, I think that in order to get this right will obviously require a good deal of input from the industry just because of the complexity of the technology and market infrastructure issues, and the private sector will have to play a significant, or should play a significant and constructive role in thinking through the best approach. But one thing I did want to highlight, which I don't know if many people fully appreciate, is that when even trying to decide whether or not you're in SEC world or CFTC world, the relationship that regulators have to their self-regulatory organizations is very different, right? The relationship that the SEC has to its exchanges and the role of exchanges in terms of new financial products and the process by which new financial products are ultimately released through listings is a different kind of process that you have over in the CFTC. And I think that one of the challenges that regulators will inevitably or invariably have to think through is however one comes out as to what a particular financial product should be. Should it be a commodity? Should it be SEC? And frankly, even you can get into some interesting sort of FTC consumer product issues that could arise even outside of the ambit of those two regulatory agencies. You're going to have to think, well, if it is under our jurisdiction, if it is our problem, what then should be the appropriate rule of those self-regulatory organizations that we do have, and do we need to think or modify how that operates in light of the specific risks and opportunities that fintech and or cryptocurrencies pose?
I'm sure if we begin to go down that road, FINRA will quickly say, "Oh, we can do it. Just give it to us. We'll grab it."
Well, one other thing, just to follow on Chris's point, is that the one thing about these offerings is the huge disruptive aspect, disintermediation, and ultimately democratization of capital formation. And so I just remember I was at House Financial Services at a hearing a year or so ago, and Representative Himes from Connecticut was asking about the age-old question of the standard 7% commissions that underwriters take in their initial public offerings. And so this is one huge potential, not that there are many IPOs anymore, and that's another problem that I'm hoping the SEC will help address, and there are lots of reasons for all of that, of course, not the least of which is litigation and whatnot. But anyway, Sarah's at the front lines of leading this democratization aspect of it. So I think that's great, holds huge promise. to help more of the proceeds from an offering to get to where it's needed most, and that's with the companies themselves and the shareholders, and then less to the gatekeepers who perform a function. But anyway, it'll be very interesting to see how it goes.
It's been interesting from my perspective interacting with there's an interesting conversation going on between libertarians and progressives about fintech generally, and about access to capital, and about particularly the lending space, helping the unbanked in that sector, where we're finding more common ground than I would have expected, and that's really fun. And I think where it's turning out, my opponents tend to be either people on the same side I work with or the other side, but who are very interested in protecting incumbents. They're always the problem.
Cronies.
Yeah,
But
right.
but anyway, but this should not be political. I mean,
Yeah.
in so many things, unfortunately, in this area of financial regulation, recently have become so politicized. But I think inherently they should not be. We're talking about how to raise capital, how to build new technology, how to protect investors, obviously, and get them the information they need to make their own decisions without having mommy state decide for them what's right or not. But anyway.
Well, and just speaking for myself on the issue, the issue of expanding services to unbanked populations is, I think, it's, to me, that's exciting, and I have some opportunities to work with other regulators in Latin America, and so the populations there, I think it's more impactful in those countries than here necessarily, but when you look at some of the access to some of those countries, the population who have phones versus the population, just virtually everyone has a smartphone, but access to banks because of geography or for whatever reason, to be able to bring these services to them via their smartphone, I think is really exciting. And again, that's not necessarily something as an association we're focused on, but something that, from the standpoint of the promise of this technology, is really, really exciting to me. So I'm glad you brought that up.
Vera, another question?
Sure. So someone's asking, what do you all think regulations will do to the liquidity of the marketplace? Would you expect that liquidity decrease substantially, or by exchange locality?
Well, regulations in South Korea kind of destroyed the liquidity of the marketplace. So I think you have a lot of different scenarios that could come about. But I think again, kudos to the CFTC for helping establish, although obviously they don't have to approve it, but to allow those futures contracts to go forward on the CBOE and CME. I think that was a huge advancement, and so I'm really happy that they've taken that view.
And I think it's also worth an initial question as to just how liquid the markets are now, right? I mean, I think that when you talk to many folks in the hedge fund industry and even investment advisors and those looking to evaluate the attractiveness of different cryptocurrencies as alternative investments and assets, one of their major complaints is, even now, just how liquid, and we're not even talking about the resale sort of ICO market. I'm talking about even the native coin question. How liquid is it? How effective? And this has to do with transaction costs. It has to do with the time issues. There are all kinds of issues embedded in that. But before one talks about should it be less, is it going to be less liquid than it is now? I think there needs to be a sober assessment as to just how liquid those markets are right now.
Well, but just to clarify, you're not suggesting that a well-diversified portfolio should have exposure to ICOs right now, right? I mean, you can get diversification through the products we have.
I wasn't even talking about diversification.
Okay, I'm sorry, I missed that part.
Yeah,
I thought you meant investment
no.
advisors and,
No.
retail
Yeah, I'm merely saying that to the extent to which people, if you're going to ask, well, will new regulations kill the liquidity of the market? Well, embedded in that question is the presumption that those markets are already liquid, right? And all I'm just trying to say is that in my conversations with a lot of people who are, on the private side, is that one of their major complaints, and it's not necessarily a regulatory complaint. It's also built up in the latency, timing, transaction cost, is that different depending obviously on what kind of cryptocurrency you're talking about, that it's not necessarily built for, many of the financial products aren't necessarily built for or based on distributed ledger technology that makes it necessarily attractive for them to begin their investment now, right? And so I think that if you're going to ask, well, what's regulation going to do, then you at least have to look at, well, where is it now?
I think one important thing about the whole liquidity issue is one of the initial attractions of ICOs was, oh my goodness, you can trade them peer-to-peer on these exchanges that had cropped up all over the world. And when the SEC is like, excuse us, your exchange looks like an exchange to us and should be regulated as an exchange. And that's made everybody outside the US go, oh, if you've got a US security thing, we don't want that on our exchange. But in response to that, without any new regulations, but building on the old regulations, we're seeing several ATSs develop. And I think in the next few weeks even, we will see a liquidity solution. I know of at least 3 ATSs, possibly 4, that should be up and running before the end of the summer. And that's going to be the regulated answer to liquidity and give you more liquidity than there was before, to answer Chris's point.
I think it's a very good point. Ironically, regulation can sometimes provide a focal point, right, for certain kinds of activities, which depending on circumstances, can improve liquidity. I would also like to say, there is a misconception sometimes that, okay, if you have these exchanges, even in the absence of a prohibition by the SEC, that you can just take one, that you can just go in and out of seamlessly different cryptocurrency ecosystems, and that's not practically the case. I mean, if one looks at private equity dollars right now, what is it all going into? It's going into interoperability questions, and those interoperability questions and issues aren't regulatory interoperability, that's market infrastructure interoperability. So again, whenever one thinks about where you're going to go, you just have to be very realistic as to where you are now.
I think part of the conversation would have to be, not just in this context, but generally, the resale restrictions on exempt offerings. We can open up a debate about that I think would be healthy too. Okay, we're getting close to the end. I want to give each of our panelists an opportunity to have 30 seconds, maybe a minute, for the last word, closing thoughts, the most important thing to remember as we walk away. Paul?
Okay, most important. Wow. Well, let's just say that obviously we've raised a lot of questions here, and they're not necessarily any hard and fast answers. And I think as people, and the regulators try to move forward, hopefully they'll be working in concert, and I think they will be. I'm looking forward to seeing what the Treasury comes out with, again, to set the tone, with respect to fintech in general. But I'm very optimistic, actually, about where we're headed. I don't think we're going to see the United States clamping down and see everything flee abroad. I think the regulators will take a measured approach and try to help through solid rules help to increase transparency, increase disclosure, and increase liquidity because of all of that. So I'm fairly optimistic.
Good. Okay. Sarah?
I would agree with Paul, actually. And I think the key words in all of this is education and coordination.
I mean, it's like innovation tri-limits. That's my article. But also just to emphasize that I think something that Paul had said. I do think this is an area and a space where, sure, there are going to be differences of perhaps emphasis, but I really do think that it's an area where people of goodwill and sort of a pragmatic mindset, where you can find a lot of bipartisan or nonpartisan collaboration, and I'm optimistic that hopefully we'll continue to see a lot of that.
Joe, last word?
Great. No, I think that's exactly right. I agree with everything that's been said in the last 30 seconds. No, I'm kidding.
The innovation tri-limit?
Exactly. Yeah. I think that's right. I think that for us, again, the focus is right now about the retail investor, but at the same time, educating ourselves, learning more about this industry, engaging with the regulators. That's, I think, so important for the folks who who want this to work and want this to happen. It needs to be, something that we can have a good dialogue about and know that, at the end of the day, we're all just trying to do right by the investors.
Absolutely.
Please join me in thanking our panel for a terrific discussion. Good job. We always wanted to do this, Paul. We should do it every quarter.
Yes.
Good afternoon. If I can ask everyone to please rejoin us as we continue on. Thank you for staying with us for the next part of our roundtable discussion. Our first panel covered the general scope of the cryptocurrency market a bit, and we'll hear a little bit more on that in just a few seconds. And there was great discussion about numerous issues and legal challenges and differing viewpoints as well. Our next panel will really zero in on regulation. Cryptocurrency, as you know, has grabbed the attention of regulators around the globe. Digital currency was one of the major topics that was discussed by the world regulatory leaders at the March G20 summit in Buenos Aires. And just this week, the UK financial regulator said it will unveil its guidelines on cryptocurrency policy later this year, which could have global repercussions. In the US, the financial regulators have already taken some enforcement actions, and the CFTC, which has oversight over the futures markets, has drawn considerable discussion about how this agency's regulatory role will take shape. As the cryptocurrency industry develops, it's important to have open dialogue about how this industry should be regulated without curbing innovation. Our experts on this panel will discuss how regulators and policymakers can help foster continued innovation in the cryptocurrency arena while also taking steps to minimize risk. Also, please be sure to stay for our keynote following this panel, which is a discussion with Rostin Benham, a member of the CFTC. He is also chair of the Markets Risk Advisory Committee, or MRAC as it's also known, and is already setting a path for the dialogue on this growing industry. And if you stay for the entire afternoon, we have a network reception planned, and we hope to see you all there. Thank you.
Okay, so I guess we're on. So my name is Gary DeWall. I'm with Cattanuccia and Roseman in New York City, although we're a Chicago-based law firm. And thank you for staying by. We're very, very lucky. We've got a great panel here today, and it's interesting. I didn't realize it until I started thinking about it. We actually have 3 people on the panel who have either current presence or roots in the Commodity Futures Trading Commission. So over to my left, what's that? Over to my left is Ryan Miller. He's an associate with Sullivan and Cromwell in the Commodity Futures and Derivatives Group. He works with financial services and capital markets. Ryan used to work with the CFTC as legal counsel to former chairman Gary Gensler. He represents financial institutions, hedge funds, prop traders, and obviously he's in the technology space, which is what we're here for. To my immediate left, Angela Walsh, associate professor, St. Mary's University School of Law in San Antonio, Texas, research fellow at the Center for Blockchain Technologies at the University College in London. She formerly was a lawyer with Ropes and Gray based in Boston, as well as with the General Counsel's Office at Harvard University. She does a lot of research in money and law, cryptocurrencies, blockchain technologies. She speaks a lot worldwide, like in DC, and publishes a lot also. To my right, we have Brian Trackman, who is the attorney lead for Lab CFTC at the Commodity Futures Trading Commission. And he's a counsel on fintech and innovation in the Office of General Counsel. He joined the commission in 2013 from the SEC. And he works on a wide range of fintech issues and is a senior member of the Fintech Interdivisional Working Group. So again, very, very knowledgeable in this area. And then finally, but this is certainly a circumstance of last is not least, in fact, last is probably most, is Jerry Bretto, Executive Director of Coin Center, a leading nonprofit research and advocacy group focused on the public policy issues facing cryptocurrency technologies like Bitcoin. Jerry has testified multiple times before Congress, state legislatures about cryptocurrencies. He regularly holds briefings and consultations with policymakers. He's presented on cryptocurrencies before the CFTC, SEC, Treasury Department. In other words, most of you guys have heard him before. He is a recipient of the Public Knowledge IP3 Award and was named one of Washington's 100 top tech leaders. So hopefully we can educate you here. But first and foremost, I do want to make sure that we start off all with the same level of understanding. And I know this could be embarrassing in a crowd where there's probably some really knowledgeable, experienced people, but raise your hands if you really aren't 100% sure exactly what cryptocurrencies are and how they work. Okay, terrific. So we're actually going to step back a little bit before we go forward, just to make sure everybody's sort of on the same level playing field. And I like to think of it as one thing. If you go to a party and someone tells you they're an expert on the blockchain, immediately know they're not an expert, okay? Because there's no such thing as a blockchain, okay? There's multiple blockchains.
There's the blockchain.
Yeah.
There's no such thing as the blockchain.
Oh, the blockchain, exactly. There's multiple blockchains associated with multiple crypto assets, okay? So that's statement number one. Statement number two is all those folks who just told me that you know nothing or you feel uncomfortable about this area, you probably know a lot more than you think you know. So, for example, that group that just raised their hands and said they were a little unfamiliar with the space, raise your hand if you ever used email. Okay, you used email. That's pretty cool. Because now you basically know how to do a transaction on the blockchain. Okay? Because effectively, the blockchain consists of things that are called public and private keys, or public addresses and private keys, which are really no different than what we deal with every day in email. I have an email address at Catton. Gary.DeWall@cattonlaw.com. Please don't send me spam. I want to send, no, I don't want to send it to Brian because I might be accused of bribing him. I want to send something to Jerry. I want to send an email message to Jerry. I've got to know his email address, okay? I have a password that I only know, hopefully, that allows me to access my email address. Jerry has a password that hopefully only he knows that has that allows him access to his email address. And literally, I type some words, I press send, and boom, the transaction moves through the internet over to Jerry. It really is not that different on a blockchain. Okay, let's talk about the Bitcoin blockchain. And again, it's a little bit more complex that I'm going to simplify. But if I want to send a Bitcoin, so to speak, or a ledger entry that reflects a Bitcoin, okay, it's no different. I have to have a public address where my Bitcoin is housed, or the entries that reflect that Bitcoin are housed. Okay, I've got to have a private key, which is no different than my password. And literally, when I use my private key to authorize the transaction, there's a signature process. And that tells the network that there's a legitimacy behind my transaction. The fact that I have the transaction, I can send it to Jerry. And once I know his address, boom, he can look at his public address. By the way, we all can look at his public address and see that he received the Bitcoin. Okay, we don't necessarily know that it's Jerry's public address, but it's that simple. Okay, very, very simplified version. Number two, that group that said they didn't really understand the Bitcoin, how many of you have used Excel? Okay. All right, great. So you're used to ledger technology. Okay, you're used to debits and credits. You're used to lines of data. Okay, and you're used to macros. Okay, you're used to the fact that you can put functionality in a box. Okay, and in fact, that functionality does things. Okay, separate and distinct from the ledgers. Okay, so keep that in mind. And then finally, how many of you have bought and sold stock or bonds through an electronic brokerage company? Okay, not as many of you. There's a lot of government folks here. Okay, but again, electronic technology. You've never, I mean, you're sending stock to somebody. You've never seen it. You've never touched it. You don't have a stock receipt anymore. You don't have a share certificate you can hang in your office. Okay, you're sort of taking it faith that it's all happening. Okay, those three elements are what basically are behind all the blockchains, with a major exception. Okay, when I access Catton's email server, or Jerry accesses CoinCenter's email server, somebody has licensed that email or probably from Microsoft, and they're administering it. Somebody is in control. And when it breaks down, you can call up somebody and say, you, whatever, okay? Same thing with the Excel spreadsheet. Somebody has licensed that from Microsoft, and somebody is administering it locally at your offices. And again, somebody is in charge. When it breaks down, you pick up the phone, and you say, you, whatever, okay? Same thing with the electronic stock trading, okay? You pick up the phone, you talk to Schwab, whoever your brokerage account with, and you know who's in charge. Fundamental difference with the decentralized distributed ledger, which underlies the blockchains that we're talking about, okay? Nobody is in charge. The systems are designed to work without anyone specifically running the system. How does it work then? How does it hold together? Well, now we understand why there are tokens, okay? Because theoretically, there is a system that allows for everybody to do transactions without trust, yet knowing the system works. The systems are based on source code that's generally publicly available, cryptography, encryption, okay, safeguards, and the system works because the system has a verification process to ensure that in the case of Bitcoin, there's not a double spend, or in case of other blockchains, there's transaction integrity. How does it work in Bitcoin? Well, when I send, and again, these are very loose words, when I send a Bitcoin to Jerry, okay, my computer, if I access and do it peer-to-peer, my computer broadcasts that transaction to a bunch of computers, and those computers keep on broadcasting it. And what the broadcast process basically does is it allows the network to verify that there are parameters that are being met within the system, it has integrity, and it keeps on getting broadcast unless some computer says, uh-oh, something is wrong here, this doesn't make sense, let's stop the broadcast. At some point, well, let's say once every 10 minutes in the Bitcoin blockchain, okay, the miners, these entities are called miners, okay, they're the folks who look for loose transactions that are floating out there in the Bitcoin blockchain space, and they're saying, okay, I have an opportunity now to solve a problem. It's not really solving a problem, it's more like winning the lottery, okay, it's like finding a combination of numbers and alpha consequences and some zeros that go before the numbers, okay, and they're saying if they get it first, they effectively get to bring the loose transactions out there in the Bitcoin blockchain into a block and seal the door. Close it shut, okay? And the first person who gets the number, okay, gets that lottery number, wins. And they get the right to close the door. And for that, they get to write to themselves effectively the creation of 12.5 Bitcoin. That's today's rewards. Last year was 25. In a couple of years, it's going to be half of 12.5, 6.25. Okay, it changes over time. But if every 10 minutes or so, all these folks out there who we've heard are called miners, okay, basically compete to solve for that lottery number. And if they win, the block is closed. All those loose transactions get into the system. They've met the integrity standards of the system. They're not double spends. The system is checked to make sure it works. And then we go on. People are doing transactions in the interim, the next 10-minute period. All those loose transactions, again, get in the block of the next person who wins the lottery. And it keeps going on. And a blockchain simply references the sequence of closed blocks piled on top of each other. And they become part of the immutable record that exists and provides a history of every single coin on the system. Okay, the first coin is always called the Genesis coin because that's the first coin. And then you can basically see the history of all the coins through the system if you have access to a blockchain. So the difference between a centralized ledger and a decentralized ledger is there's no one in charge, but there's a system to maintain the integrity of the system. And that's why there's a relationship between coins, particularly in Bitcoin and blockchain, and the ledgers. So folks who say, I believe in ledgers, but I don't believe in coins, what they're telling you is they like fancy Excel spreadsheets, okay, with macros. That's all they're telling you. Because when there's a consortium and they want to use blockchain technology, what they're really saying is they want to use fancy Excel technology. Okay? When you're talking about blockchain as a decentralized application, you are talking about this system for which nobody is in charge, yet the system has integrity. Jerry, you want to say anything else? Did I get it basically right?
Yeah, I think unfortunately it's kind of like trying to explain how a 747 works.
Right.
You could do it. You could describe it using English words. You could describe completely how a 747 works, but it's very, very difficult to get it, especially in one go in the 5-minute period. But yes, generally in broad strokes. The only other thing I would sort of highlight, and you got to this, but what I would highlight is this: is that to me the most important innovation or the most important thing that this technology allows us to do today that we couldn't do before is the invention, the creation for the first time of digital scarcity. That did not exist before Bitcoin. Bitcoin introduced the concept of blockchain technology, by which we mean open blockchain networks. Before the invention of Bitcoin, for two parties to transact online always required this third-party intermediary, right? This somebody who's keeping a ledger. And why did we do it this way? Well, there's no way before the invention of Bitcoin to have a pure person-to-person transaction, right? If you think about a person-to-person transaction, what we're talking about here is a cash transaction. So I take out a $100 bill, I give it to, no, I can't give it to Brian. I give it to Gary, and he's got the $100 bill, and I no longer have it. And we can verify this by looking at our hands. He's got it, I don't. And the reason that works, and there's nobody else between us, right? We could be, out in the mall, and nobody's around us. The reason that works is because of physical scarcity inherent in physical space, right? Give him a $100 bill. If we tried to do that online, replicate that electronically, what would that look like? Well, we'd have to represent the $100 digitally somehow, and so maybe we would have like a $100 file, and I could send that to Gary, maybe through email. I would attach this file to an email message, I'd send it to Gary, and now he'd have the $100 file. But what about me? Do I no longer have the file? Think about when you send somebody a photo or a Word document. They have the Word document now, but is it gone from your computer? No. You retain a perfect digital copy of what you just sent. And so if that was money, it wouldn't work. And so this is why we employed third-party intermediaries, something like Bank of America or DTCC or whoever, right? You have to have a third-party intermediary. So when I want to send Gary $100, I don't message Gary, I message PayPal. And I say, hey, PayPal, please deduct $100 from my account and add it, minus 100 from Jerry, plus 100 to Gary in their ledger, and that reconciles to zero. What Bitcoin does, what it invented, is a way for me to, and this is where I do the hand-waving stuff because it's going to require the 747 explanation, but it allows me to broadcast a message to a network where there's a ledger, it's called a blockchain. The ledger is not kept by any one party. It is actually a copy of the ledger is on the computer of everybody who's connected to the network. And it allows me to say minus 100 from Jerry, plus 100 to Gary in such a way that I'm not relying on any third party. There's no third party that can say to me, you know what, no, we're not going to do it. Or actually we've gone out of business or whatever. And so that's unique. Because now you have essentially what you had in cash in the physical world. You had that ability where I could give Gary $100 and now he's got it and now I don't. Now I have a Bitcoin and I can give it to Gary and now he's got it and now I don't, and we can verify this by looking at this blockchain. And if you can do this for cash, so I'll stop talking, I promise. There is this economist at the Chicago Fed called Francois Velde, and I heard him once say this, which is I thought very, very smart. He said, Bitcoin is a system for securely and verifiably transferring Bitcoins. And you're like, that's redundant. What does that mean? That's recursive. What he means is this, is capital B Bitcoin, the network, the system, the protocol, is a system for securely and verifiably transferring lowercase b Bitcoins, these tokens. And that's all the system is. It just allows you to trade. Like, I have a Bitcoin, I send it to Gary, now he's got it. That's all it does. It just keeps track of who's got what and who sent it to whom at what time. We have assigned a value to these Bitcoins because we've got markets. At some point, somebody said, I've got a Bitcoin, and they're scarce. There's only 21 million of them. somebody want to buy one? And somebody said, sure, I'll give you $1. And I sent it to them, they gave me $1. Now a Bitcoin is worth $1, right? And so, through that process, you've got a market, there's more interest, it's more liquidity. Today, a Bitcoin's worth about $6,000, $7,000. So the first application of this technology, of like Bitcoin, is money, right? The tokens represent money. But there's no reason why that's the only thing these tokens have to represent. They can represent anything that we agree the tokens represent. So you can have a token, and we can say this token represents an ounce of gold, or this car, or this house, or this share of stock. And once you do that, the possibilities are endless, because now you can have trading that is peer-to-peer, that's scarce, right? So think about copyright. If I buy a book at a bookstore and I'm done reading it, and I want to lend it to Brian, or I want to sell it on eBay, I can do that. Why can I do that? Because there's something called the first sale doctrine in copyright, which says that once you've bought something, it's yours and you can sell it, even though somebody else may own the copyright. And the reason that it works is because of physical scarcity. If I buy a book from Amazon for my Kindle, and then I try to sell that or lend it, I can't unless Amazon gives me permission. And that's because there is no digital scarcity. I can't prove to Amazon that when I give it to Brian, I no longer have it. I may have retained the copy. So this technology now allows us to do any number of things if you can conceive of now having scarcity online digitally.
And because we do want to get to the topic at hand, just 2 other points. So keep in mind that Bitcoin became public in 2009, right during the financial crisis. Right during the financial crisis. And I'm not here to defend, and I'm very neutral. I don't own any cryptocurrencies. I don't invest personally. But one of the key benefits of the technology, and it's an ancillary to what Jerry is speaking about, is because there's no single point, there's no intermediary, there's no central point. It reduces the risk of compromise. It reduces the risk of hacking. Okay, I could hack Jerry's computer, but it wouldn't have any impact on the blockchain. The blockchain is on everybody's computer. I could hack it, a whole part of the world could disappear, but the blockchain would still, that relevant blockchain would still exist. And the records would still be there of all transaction history. So there is the theory of this is that by removing the point of centralization, you reduce the risk of a compromise of the integrity of the system. Now, you're probably saying, well, I read about hacks all the time. They're not the hacks of the system. They're not the hacks of the relevant blockchain. They're the hacks of the intermediaries who are accessing the blockchains. Okay, fundamental difference, fundamental difference. The other thing I just want to re-emphasize, there's different use cases. Each coin out there, each blockchain out there has a different use case. The use case of Bitcoin is very different than the use case of Ether. The Bitcoin blockchain is very different from the Ethereum blockchain. The Ethereum blockchain is really more for facilitating transactions. The Bitcoin blockchain is really meant more for engaging in being a virtual currency. So when you look at each blockchain, the first and foremost question is, what is the purpose it's serving? And never get overwhelmed by these definitions of it's a security, it's a utility, it's a coin. You really have to dig deeper than that.
We will say you want to focus on those definitions
Yes.
for a lot of other reasons, but yeah.
Yeah,
don't be
for legal
overwhelmed.
reasons. In fact,
Yeah.
let's do a quick pivot because, again, we don't want to review old territory, but there was a comment that, whether we should be looking at Howey, whether we shouldn't be looking at Howey. Ryan, I know you have some thoughts about examining Howey at this point.
Sure. So when the SEC first released documentation or thinking or a paper on virtual currencies and digital tokens, this is basically late summer 2017, they published the DAO report. The DAO report relies, as we expected they probably would, on a traditional approach to the Howey test. That's 4 factors. Let me just say those, but then explain what else we think the SEC might be able to do there. So the Howey test is a contribution of money with the expectation of an increase in profits in a common enterprise, and then the expectation of the increase in profits is based on the efforts of others. Fairly straightforward. It comes from a case, maybe it's 1930s, 1920s, I don't know. But it's about orange juice groves, maybe in Florida. Wonderful. And the suggestion was perhaps the SEC is looking too narrowly at precedent from a different world, from a different era. That's a fair point. JW made that point. And I think the SEC itself has recognized that. As you go later into 2017, there was the Munchie case, the Munchie ICO case. Again, without doing a case brief or a case summary, Munchie created a food review product or platform, and the tokens were to be used, I guess, earned if you provided reviews, to be rewards for reviewing different food items. They were selling the tokens in exchange for cash. They did two other things that the SEC's enforcement order found were meaningful. One, the Munchie promotional efforts or advertising efforts indicated that they would support a secondary trading market for the tokens. And to the SEC, that was important. That's a factor that's not in the Howey Test, but it's identified in the Munchie order as something relevant to the securities law analysis. So if you're issuing something, and in connection with the promotional efforts of issuing that something, and you're collecting money for it, and you're saying we're going to support the creation and viability of a secondary trading market in this something, that now is relevant to your securities law analysis. I think we don't think that was a stretch, and fair point. Separate from that, the Munchie case, and this is consistent with Howey, focused on promotional efforts that said the tokens might go up in value. There's a possibility that this could increase in value. So it's characterized as an investment. And so the SEC didn't feel clearly constrained solely by Howey. They're looking at a broader sense of what might be a security. To counter that, and to bring in a few additional thoughts, Chairman Clayton recently said that something might be a security at the time it's issued, and perhaps at a later stage in the life of that project or the product itself, it may no longer be a security. He allegedly said this at a Princeton classroom or a student lunch. We don't have a transcript of it, but it appears that the SEC itself is still thinking through these issues. The last piece of precedent, I think, to put out on the table that I think augments or supplements the Howey Test has to do, and bear with me for a second on a tangent, with something called personal seat licenses, and typically associated with professional sports stadiums. In 2006, there's an SEC no action letter. It's on their website. It's still there today, issued to the San Francisco Baseball Association. So they're building a new baseball stadium. They need money to build a stadium. You can't build it for free. So they sell something called a personal seat license. And what that is a perpetual right, or maybe a 10-year right, maybe a renewable 10-year right, to buy season tickets every year. The reason, and it's not a sale of season tickets, but it's a sale of the right to buy season tickets every year going forward. The stadium developers sell this, they get the money, they build a stadium. In connection with this, the personal seat licenses are traded. They're tradable on the secondary market. You can buy and sell them. So there, the no action letter says, for our current purposes, not a security. I think that's helpful precedent. It's not something we see mentioned in the Munchie case or the DAO report, but I think it's something, if you get into a litigation phase, let's say the SEC goes after a project or a token issuance that's not quite ready to settle and not quite ready to concede that it's a security, you're going to see precedent like that and potentially other precedent brought into the table.
Yeah, I think what you say, Ryan, is just an outstanding point. So right now, and again, I'm going to digress a little bit. There was a time, and I can look at the audience here and say probably most people here, including myself, were not practicing or in the field at that time. There was a time in the 1970s when, because of the increase in prices of commodities, something called commodity options began to be traded in the United States. They were offered and sold by a lot of bad people. In London, they were sometimes called London options. In London, they were typically backed by real commodities. In the United States, they were backed by nothing. There was all sorts of debate. Are these securities? Are these futures? What are these? Who regulates them? Lots of confusion. Among other reasons, this confusion was the reason why the Commodity Futures Trading Commission was created in 1974, and the Commodity Exchange Act was amended to define commodity broadly to not only be something that was one of the enumerated commodities, but were other goods and articles, as well as rights and interests on things that today might trade as a futures contract or tomorrow trade as a futures contract. And the CFTC was given exclusive jurisdiction over derivatives effectively based on commodities. That was in 1974. In 1975, the CFTC began work. Notwithstanding, it brought something like 60 injunctive actions by 1977 against bad people, or allegedly bad people, selling commodity options. It couldn't keep up with it. It asked, and Congress changed the law to basically say, time out. No more commodity options except for, I think it was 3 grandfathered entities, until the CFTC could feel comfortable regulating this area. They didn't feel comfortable until about 1981, when they came up with a pilot program for commodity options. In 1982, commodity options started trading again. Chicago Board of Trade had commodity options and some other products. And today, 30 years later, people scratch their heads saying, what is he talking about? The problem with commodity options? There's no problem with commodity options. That's right. But there were. Okay? There was regulatory confusion because it was a new product. No one really knew what box it fell in. The one difference we have now, the one issue we have right now, we're at the infancy of a new financial product, but there's not a lot of case law out there. So far, there's been one significant case in the Eastern District of New York a couple of weeks ago involving a CFTC enforcement action called CrowdCheck. And in that case, the court upheld CFTC jurisdiction for purposes of a potential enforcement action where there was allegations of fraud, and the CFTC was relying on its new Dodd-Frank authority. Other than that, there's really nothing been out there. Ironically, another judge in the Eastern District, sitting literally right next to the judge who heard the Cabbage Hack case, is currently hearing a case on on what is a security. It's actually a Justice Department case. It's a criminal enforcement. Maxime Zavlisky, I think it's RE coin and DR coin, and the same issues are coming up. How could you how could you indict me for securities fraud when we're not talking about securities? And the arguments of whether something is a security is a front and center in that case. The Justice Department, with a brief of the SEC, the defendant, have all said either it is a security, it is not a security. Interestingly, the defendant not only said Howey doesn't apply, but they also said, funny, I looked at the Securities Act, and it expressly exempts currencies from the definition of securities. And I don't know, cryptocurrencies, it doesn't say fiat currencies are exempted. It says currencies, and these are types of currencies. So there's oral argument in that case. I believe it's on April 27th, and that likely will be the first real decision in this space. And over time, more case law will be developed, and we'll have a better sense of where things might be, relying on stuff as it is. Because right now it's just been FinCEN that's given edicts, the states have given edicts, the CFTC has given edicts, SEC has given edicts, no impartial arbiter has really been involved. But now we're going to pivot to what we should be speaking about. It could come out the wrong way. And I don't know what, we probably all have a different view of what is the right way and the wrong way. But I think that most folks in this world don't want a situation where bad guys are getting out because, in fact, there is ambiguity in the law, and they're able to exploit that. I don't think anybody who's in a legitimate space wants that outcome. And there's a concern that may happen. So the question is, if we can do something now, and we can help create laws or regulations or do something that makes things better, what would that be? And Jerry, let's start off with you. What would smarter regulation look like in this space?
Well, so I could say a couple things, and I do want to leave time for Angela and Brian to
no,
get in here.
No, she's next. Don't worry. We're going to get her in. Absolutely.
But look, I think when you're talking about cryptocurrencies broadly, one of the biggest regulatory impediments to the sort of responsible growth of this ecosystem is state-by-state money transmission licensing. So if you have a business that deals in cryptocurrencies, or if you don't have a business, even if you're just a developer or an academic that's developing software related to this, you may be implicated by state money transmission licensing. State money transmission licensing is basically the main way that we do consumer protection at this point related to cryptocurrencies. State money transmission licensing really is meant to address, originally things like Western Union, things like money orders, and the impetus for them is basically this. Let's say you have low-income person, lives paycheck to paycheck. They need to pay their electric bill. How do they do this? Well, they get their paycheck, they cash it, and then they go to the store where they're buying their groceries and they buy a money order. Take the money order, they mail it to the electric company. Electric company gets it, they go to cash it, they go deposit it, it bounces. Why did it bounce? It bounces because in the short period of time, between the time the person bought the money order and the time the utility went to deposit it, that company went insolvent, went out of business, ran away, got hacked, whatever. And so that presents a risk to consumers. You have an entity that is not a bank. Banks are regulated, in a certain way. It's not a bank, but it's in the business of taking custody of consumer funds in order to move it, right? Western Union, money orders, that kind of thing. And they present a risk to consumers. And what kind of risk is it? It's a custody risk, right? It's an insolvency risk. Even if it's for a short period of time, they're presenting a risk to the consumer. And so the way that we addressed this was through money transmission licensing. We basically said, if you're in this kind of business, you have to get a license. And the problem is, for what we're talking about, is two things. Number one, it's state by state. That made a lot of sense in the 60s when these laws typically emerged. These businesses tended to be state-based or regional. Today, fintechs are, if not national, they're global. Right? They're internet companies on day one. They're everywhere. It's really inefficient to ask firms that need to get licenses to go state by state because the 50th background check that you passed to get a license, you're no safer than the first background check that you passed. So that's one inefficiency. But probably more importantly from my perspective is this. These are money transmission licensing. What is being licensed is the transmission of funds, not the custody. Remember, custody is what presents a risk. But that's not what's being licensed. What's being licensed is transmission. And if you look at the statutes, and it'll say, if you're in a business of transmitting funds, you must be licensed, right? No one may be in a business of transmission of funds without a license in this state. Well, what does transmission of funds mean? Transmission of funds means the movement of funds through wire or any other means. Okay, very broad. So if the risk is custody, why is the regulated activity transmission? The reason is, going back to scarcity, before the invention of Bitcoin, the only way to transmit funds for somebody is to take custody of it and transmit it for them, right? You had to have a third-party intermediary. With the invention of Bitcoin for the first time, you can provide a service that transmits funds without ever taking custody of the person's funds. You could provide a wallet software. You could be a miner on a network. You can be a node on a network that relays messages. And in each of these instances, you may be performing a function where, in a plain English sort of fashion, you are transmitting funds, you're helping in the transmission of funds, but you're never taking custody of the funds. Therefore, you're never posing a risk to the consumer. And so therefore, requiring a license from you makes little sense, even though that's the law. And so addressing that, I think, is one of the most important things that we could do. Related to that, there are anti-money laundering questions. There's obviously questions with securities, but maybe I'll stop there.
Angela, what would be some of the things you think should be addressed by smarter regulation in this space?
Well, can you hear me? Yes? Okay. So some of the things I think we would need to focus on with regulation are, first of all, clarity, I guess. Clarity and predictability. So there's been this whole dance, I think, going on for a number of years where regulators, policymakers have been looking at these technologies and trying to get a handle on them. And a common mantra that we've heard from them is that we want to take action at the right time so that we protect consumers but also don't stifle innovation. So finding that magic moment has been what people are trying to do. And this has been going on a while, right? So regulators feel like they've got a decent handle on what the technology is. It feels to me like we're at that moment where clarity is actually needed or innovation is potentially being stifled. You see lots of complaints about this, and I think that's part of the reason that we're seeing a lot of state legislatures actually beginning to take action trying to give entrepreneurs in the space some comfort and clarity about at least what they can do in that state. Now, that's pretty complicated when there are overlying federal regulatory structures that people still have to fit into, but at a state level, maybe you could know what you're doing is okay. So I think there's, definitely we need to seek clarity. And I think one of the complications that this whole phenomenon with cryptocurrencies has demonstrated is, we have a very complex, strange, hard to navigate regulatory framework at a federal level when you can fit into multiple categories, right? And have to figure out how to comply with all of them. So I see that being, a challenge that entrepreneurs will want to see resolved if this goes forward. Now, I think there are some challenges here that we're facing and will continue to face. And one of those is education and understanding of the technology by policymakers and regulators. And I bring that up because we got a great description of blockchain technology, cryptocurrencies in particular at the beginning. But I, for one, would quibble with a number of the things that were stated as this is the way that it is. So when we're talking about we have new financial products that we're introducing and have to figure out how to deal with those, well, those are financial products that are actually based on an underlying technology that remains immature and I think poorly understood. So I'll just give you a few examples of where my quibbles might be, but they're significant, I think. So one of them is about the very basic statement that no one is in charge of these things. We have decentralized organizations, so no, you don't have to worry about one person running the show. Yes and no, I would say. And we've seen in many of these public blockchains even, powerful entities, powerful groups emerge, the core developers of these systems, the software developers who continue to operate them after they exist, right? Make important decisions about policies that are implemented in the software and how those should be coded. You also see power structures that have emerged within these transaction processing networks, the miners that were discussed. In many of these public blockchain systems, the mining networks are heavily concentrated such that they control significant portions of the computing power in the network. So it's very easy for one or two of them even to collude to take control of the system. So people are still exercising power here, and I feel like that's often lost in this discussion of characterizing these systems as decentralized. So great, all power questions are off the table. I've kind of become known as an annoying person who says that immutable is the wrong word to describe these systems, and I could go on for a while after that. I won't bore you here, but let's just call them hard to change. And I get very worried as well when I hear them described as unhackable when particularly the concentration of mining networks makes 51% attacks not just a theoretical, it is, I guess, a theoretical possibility now, but it's one that could actually happen very easily because of concentrations of power. So.
And I tend to agree with you. It's interesting because we at Canton represent a wide variety of clients, who are involved in this space. And one of the questions we get more and more is, what kind of due diligence should you do when you engage in a transaction on a specific blockchain? Because again, it goes back to the same issue. No two blockchains are necessarily the same. No two networks are necessarily the same. And there are issues about how they were issued, how they came about in the first place, how do they trade in the secondary market, what were they marketed as, what's the purpose of the underlying project, is there legitimacy to the underlying project, how is it coded? There's all sorts of questions. How can anybody run the system? Can anyone get a majority? So again, it goes to that point. Brian, I'm curious your views on the subject.
That's great.
But I was also going to say, in fairness to you, I know that your views are not the views of the CFTC, and may not even necessarily be your own views. But feel free.
One of the most important parts of what I do every day is listen. It's probably the most important part of the job. So that's what I've been trying to do just now. And if any of the rest of you have been thinking, some of the things that are getting said don't seem to quite line up. There seem to be a diversity of views, both between the panel we're on now and the previous panel. All I can say is welcome to my world. Thank you, Gary. Let me start just by thanking the Mercatus Center and IFM for putting this together. Really pleased to be here. Gary, you're correct. Nothing I say, including what I just said, necessarily reflects the views of anyone but myself, certainly not CFTC staff or the commission or any individual commissioners. But,
By the way, your family members told me you don't represent them either.
It's true. I hope not. As the conversation was progressing, I think, just a couple of points that I thought would be worth making. I don't want to get into the specifics of the ongoing and very current debate about who's going to be ultimately in charge and who has the jurisdiction. So much of this is facts and circumstances based. The reality right now that we're in is a world in which the permutations, the ways that these virtual currencies can be set up in the digital tokens is so broad and so vast that making generalizations it's a fool's errand. It really is. And so rather than get into that, I will just observe that it's not at all surprising, given that there are different regulators in Washington and at the state level as well. It's not at all surprising that given the advent of the new technology, that different regulators are looking at this, at least not to my, from where I sit. In fact, it would be surprising the other way. It would be surprising to me if at where we are today, we are very early in what I view as a long-term evolution. If you think back to just a few years to the advent of the internet, how many people, everybody remembers pets.com, right? It was great. It was great for about a year. And it's gone now. That's true of a lot of the early internet pioneers. There have been a few that we all hear of now. Most of them didn't exist back in the year 2000. So there's an evolution, I think. I think we really are in 1.0. We're heading towards a 2.0. That was, I think, an important point. And as that evolution develops, I think there'll be increasing clarity. That was one sort of broad observation. I try to keep my comments short. Jerry mentioned scarcity. I recognize the value of scarcity, so I'm going to do my best.
I do have one question for you. Lab CFTC. What is Lab CFTC?
Yeah, no, it's great. So I was. That's excellent. I'm so glad. I'm so glad you asked. So Lab CFTC, and here I want to actually step back. We did launch in May of last year, and I want to acknowledge the colleagues that I have the pleasure of working with. Many of my CFTC colleagues are in this room. I want to specifically acknowledge George Harada, who's here. I work with him on a day-to-day basis. Our director, Daniel Gorfine, and I especially want to acknowledge what I think is the vision of our, the good vision of our current chairman, Chris Giancarlo, who even before becoming the current chairman was front and center on technology issues and understood the impact that these things could be having, not just this month or this year, but really for the next several years. It's my pleasure to be involved with this project, which is the Lab CFTC initiative. A big part of what we do and have been doing, and let me do a quick pivot back to the stated topic of the panel, which, as I understood it, is what should regulators be doing? And I guess I would recast that a little bit as, at least from a CFTC perspective, what are regulators doing? Because the fact is, we all are already doing. And so, Lab CFTC, I think the fundamental vision is it's very difficult to have any real, meaningful, constructive insights about how to regulate, really where to insert, without actually knowing where we are. And the reality is, especially with when you're talking about cryptocurrencies, that the technology, whether you want to use the 747, how does it work analogy, whether you want to give the high level, let's keep the hands down and not waving too much, broad high level overview of it, this stuff's complicated. It's not easy. And so the idea that a regulator, any regulator, is going to come in at this day one, even day 100, and really be in a position to act meaningfully, at least to my mind, it's a non sequitur. So rather than try to do that, what we've been doing at Lab CFTC is doing a lot of proactive engagement, and that's really front and center of what we do. We are meeting with innovators, we're meeting with counsel, we're meeting with all segments of the industry, individual right up to the largest incumbents. We're hearing from them about what they're doing, and what we're hearing is a wide range of applications. We are seeing a number of different specific verticals of interest, whether it's in the supply chain space, whether it's in the cryptocurrency space, whether it's trying to figure out ways of making banking more accessible to people who've been underserved previously, whether it's trying to operationalize energy markets that haven't been working very well, or not maybe as people think as well as they could up until this point. People are seeing possibilities here that they didn't see before for some of the reasons that I think Jerry was alluding to earlier.
Quick stop. Some jurisdictions, for example, Singapore, has something called a regulatory sandbox.
Sure.
What's the difference between a regulatory sandbox and what you guys are doing?
That's a fair question. So FCA in the UK, Singapore, Hong Kong have what are dubbed sandboxes. Some people are big advocates of these. The simple fact is we at the CFTC don't have authority to do a sandbox along the same lines as some of these other
And I believe the SEC
jurisdictions.
doesn't have the authority either. Is that correct?
Not to my knowledge.
Can we come back to that?
Sure.
I have a view, yeah.
Good.
Yeah.
We're gonna,
Yeah,
Okay.
yeah. So
Yes,
the sandbox idea is something that we think we can replicate and even maybe do a little bit better with authorities we already have. Those include our no action framework, and if you look at an agency like the CFPB and their Project Catalyst, they've been using that no action framework to actually scope ideas and projects. Beyond that, we're actually looking and kind of excited about the possibility of launching some prize competitions using authority under the Science Prize Competition Act. And so,
would the prizes be paid in Bitcoin?
not monetary prizes, Gary. Not monetary prizes. You get the satisfaction of knowing you're a winner. But as a first step to that, we're hoping to crowdsource some ideas for what the topics might be and how that might be best be administered. So we're pretty excited about that. And in many respects, we think it sidesteps some of the issues that have been raised in relation to sandboxes, and I'll mention just one. There's this idea of on-ramping. And the concern that's been raised, and it's coming from the innovator community, is that if an innovator is not selected by the relevant jurisdiction to participate in the sandbox, they're finding it difficult to get funding, they're finding it difficult to get traction with others, that their idea actually has some legitimacy and some value, some potential value. So we sidestep that. We don't want to get into that kind of issue, and we think that this other authority we have may be very helpful, and we're excited about it.
Okay, so we just heard one possible way of developing a path forward, which is the use of the no action letter. Ryan, why don't you think about, are there other things that could be done, and you feel free to comment on anything that Brian has just said.
Sure. Yeah. It's, lots of different places to jump in. When you do these talks at business schools, they're all about competitive advantage. How can we build something that's that's going to scale, et cetera? And you remind them that regulatory and compliance, having that sorted out on the front end, is a huge competitive advantage, and it's why most companies that do scale and become market leaders find success. They sort out regulatory and compliance up front, and so the business school folks aren't always receptive to that advice, or it's sort of you have to drag them to that table. But this is very important to the viability of projects, sorting out where you are from a legal and regulatory status. Okay, and then so how do we sort out the fact that some of these projects or tokens or products are arguably falling under a series of different regulatory regimes that conflict? That's sort of the problem set. And so I work at a law firm. We bill by the hour, so we go as far back in time as we can and start reading everything. And here, you really get to go very far back. You start with the Old Testament. This isn't going to take that long.
We did refer to the Genesis.
Yeah. He said Genesis earlier, so I got to bring in the Old Testament. Nothing new is under the sun. There's nothing new under the sun. Oh great, so there must be precedent somewhere. That same book says everything is meaningless, so we got to sort of work our way through it carefully. But nothing new is under the sun. So where have regulators, and so now we jump forward several thousand years, where have regulators looked at overlapping jurisdiction or unclear jurisdiction and provided some solutions that worked, that allowed products to go forward? To me, the most recent, place and it's CFTC, SEC, and not Shad Johnson, we're going to come forward a few more years, is commodity-based ETFs, or exchange-traded funds. You have ETFs that hold underlying physical commodities, gold and silver being two of the largest and most prominent. There was an agreement made up front between the regulators that you put the gold in a trust, you put the silver in a trust, you sell interest in the trust, the interest are securities. Fine, that ETF share is a security. But then the next question came up, well, let's do options on those shares. And the CFTC economists keep thinking about it, they keep looking at it. Options on shares of an ETF that only holds physical gold is the same exact economic product as options on gold itself. We, the CFTC, get options on gold. Why should the SEC get the options on the ETF shares when that ETF is just gold? So did we ban them, as we did with options in the late 1970s? No. The CFTC and the SEC came together, and without getting into the statutory sites, they both have general exemptive authority, and the Commodity Exchange Act and Securities Act nerds in here, and there are a lot of you, will say there are limits on that exemptive authority, but they did harmonized dual exemptive orders. And they said, we're going to let the options on ETFs sit on the SEC side of the regulatory environment, subject to certain compliance with CFTC fraud and manipulation concerns. The CFTC reserved their jurisdiction for the purpose of those core regulatory interests, but they otherwise let that product trade on the securities side and be cleared by a securities clearinghouse. That's not a direct fit for what we have in the digital token space, but the concept that the two regulators, particularly the SEC and the CFTC, can do harmonized exemptive orders exists, and it's been used before.
Let's talk about one specific currency and how it might be resolved. So Ether is a very interesting digital token because there are Ether tokens out there that were issued once upon a time as part of an ICO, initial coin offering. There are Ether coins out there that are issued each and every day as part of this process of mining, which I described earlier, which is generically called proof of work. So we have different types of Ether out there, each origined in a different way. If you just pick up the newspapers, those that are subject to an ICO could be considered a security, according to things that the chairman of the SEC has said. Those which are mined are more like virtual currencies in many ways, and probably not a security. How could practically something like that be resolved so people going forward could know, is a derivative based on a Ether token something under the SEC? Should it be going to the SEC to get approval, or should they be going to the CFTC to get approval? Ron, you want to continue with that?
There's a lot in there.
That's why
I think, here's one way it can be done. Here's what they did with Bitcoin. The futures exchanges stepped up and said, we clearly think it's a commodity. The market has taken that view. We don't have any guidance otherwise. Let's put a futures on top of it. Now you've got a futures contract on Bitcoin trading on CFTC registered futures exchanges. Bitcoin has to be a commodity. The water is so far under that bridge. So then you would say, all right, we have another token, Ethereum or Ether, however you want to call it. If we put a future on top of that and put it on a futures exchange, it seems pretty clear that it's a commodity and not a security. And so how does a futures exchange get comfortable that it's able to take that step? Maybe it just takes that step. I'm not sure.
I also think if you are the SEC and you're inclined to say, look, Ether's a commodity, but we still want to address the question of the initial ICO and the propriety of that offering, there's a way to split that baby for the SEC, because with the SEC...
Old Testament, again.
Old Testament. Old Testament. What the SEC could do is simply address that issuance to initial parties, and maybe that was the issuance of a security. The token today, as it's operating, is a commodity, and these are two separate things. That's one view that's totally defensible, I think.
Right. So, is there precedent for products that fall within both jurisdictions that change characteristics over time?
This is like law school.
I know.
Uh-huh.
Yeah.
So he told me to read something before. So there is precedent, Gary, surprisingly. So we heard about SEC 21A reports, which are issued through the Enforcement Division. I think the commission actually signs off on them being issued. I'm not sure. 21A report allows the SEC to say, we see an area where we could take enforcement, but for a series of reasons, we're going to not take enforcement, but tell everyone to do better next time. And where they've done this in the traditional futures space, there was one in connection with Eurex, which is a European futures exchange. They offered a futures contract on a broad-based securities index. Over time, the components of that index were reweighted such that the index became narrow-based as opposed to non-narrow-based. Far too deep of a distinction to sort through for this group. But the point is, a non-narrow-based security index is a CFTC product. Narrow-based becomes a security and an SEC product. What the SEC pointed out was, if you're going to list a futures on something that its character can change from a non-security to a security during its lifetime, you need to monitor and prepare for that and comply with both sets of rules. So 21A report says, we're not really excited about what you did. We're not going to put anyone in the enforcement timeout box, but here's how we expect you to do this going forward. Absolutely an item of precedential value that they could look to.
So I think the bottom line is, I think that within the current regulatory framework, there's certainly some basis for clarifications that could help clarify some of the distinctions I think people in the business need. Obviously not necessarily binding on courts in the long term. You do have some courts out there that are now beginning to think about this thing, and we'll see where this evolves. Whether there'll be legislation down the line, I think is still yet another unresolved question. A lot of the ability of the SEC and the CFTC to sort out the current jurisdictional battles are based in legal authority. So whether that legal authority is broad enough to cover this area is time to be told. But Angela, before we start taking some questions from the audience, I know you have an interesting thought about what we call the unintended consequences of blockchain technologies and what the implications of those are on society and how those things might be addressed. For example, the fact that miners require a lot of electricity to just go through the process. Maybe you can talk a little bit about some of the unintended consequences that we're not necessarily thinking about in connection with blockchain technologies.
Yeah, so I think because these systems like Bitcoin came in, and the first use case, kind of as Joe described earlier, was potentially as a currency, definitely having a financial aspect to it. We've seen it in the through the financial regulatory lens, right? So we've talked today about all the different financial regulatory agencies, how they might have something to say about it. But it's really interesting that I think because there are other potential uses of it, and because there are complications potentially in how these systems run, we could be seeing, I think, down the road some other regulatory implications, or at least connected to law. One of those, and we're seeing some discussions about this in the U.S., some disputes, is that there have been miners, and you may have seen these articles, transaction processors in various small towns attracted to low electricity prices in those towns, going in and putting a big toll on the electrical grid there, and to such an extent that like city councils and those types of people have put limits on their ability to tap into the city's electrical grid. So kind of in response to that, we've seen legislation proposed, I think in Arizona, to say that actually no counties, no cities can take action to prevent people from participating as a node in one of these cryptocurrency systems. So I think that's a battleground that we may see. Like, how are these systems going to be tapping into our infrastructures, our existing real world infrastructures, and we're going to have a fight about those resources, because they're not existing only in the sky here, right? They're actually connecting to the real world. Other places that I see potential discussions coming are in maybe even the antitrust world, right? I was talking about these mining pools having significant portions of the power of these networks. Well, collusion becomes a possibility here, and we speak of them generally, these public blockchain systems, right, as they're autonomous. You don't have to worry. They're just thousands of nodes that just run. Well, antitrust deals with questions of power. I think there are questions of power that are going to merge. Those are just two examples. I think there's going to be a million of them.
And one other thing, Ryan, I forgot to ask. Internationally, are there any examples of other regulatory bodies globally taking some interesting steps that might provide some guidance to where we may go in the United States.
Yes, I'm mindful of the time. I mean, every country has a view on this. The sandbox approach you've seen that is the most successful usually focuses on a limited consumer or target user base, a user base that doesn't necessarily need the policy protections that you think of that you would want to have for a retail consumer. I think those are the best examples. I'm not sure that I can pull out specific countries and what's been done, but there's sandboxes like in Malta and jurisdictions usually thought of as tax havens that have said, let's be regulatory havens as well.
You know, one development on the international front, which I think is an interesting trend that we're beginning to see, is that certain jurisdictions are starting to give guidance on classification of different kinds of tokens and currencies. And I think that one overarching view, and I think this alludes back to some of the comments already made, is that you can really begin to see how cryptocurrencies, that is currency-like tokens that serve a purpose of either medium of exchange or store of value, are starting to be distinguished by more and more people looking at these from, let's say, the asset tokens, which are more like securities, arguably, and then some of the more commodity-like tokens. And there's still a lot of gray area, but one place, recent guidance out of Switzerland, I guess that was in February of this year, that's been one example, but there have been several. And then the other trend that I think is worth noting, maybe as a counterpoint to my earlier comment about maybe our sort of effort so far to be proactively engaged as opposed to jumping in 2 feet and trying to regulate a space we don't yet fully understand. Certain jurisdictions feel like they have no choice but to do that. The one example, which I know Gary has written about, being Gibraltar, and there, based on the conclusion that on a statutory basis, these ICOs and other cryptocurrencies were simply not subject to any regulation because they didn't qualify under the statutory definition as a security, the decision has been to propose an entirely new regulatory regime, which is interesting because of its focus. The focus is on the secondary market trading and not on the primary issuance of the token. So those are just a couple of high-level.
And Jerry, I guess to your earlier point, I suppose that if there is a desire to get money transmitter requirements out of the system, the only way that can be done is through some kind of preemption, which would require some kind of legislation.
I think that's probably right. And I think if you want to look, and to be honest, I think the U.S. has really been the leader when it comes to regulating in this space. But if you want to look overseas, you can look at, for example, the EU's e-money license, where there's a passporting system among the member nations. So if you get an e-money license in France, you're good to go in Germany and Spain and everywhere else. So you can imagine federal preemption of state money transmission licensing happening in a range of ways. The simplest one could simply be require passporting. So if you get a license in Alabama, it's good in Hawaii. Obviously, this is going to there's going to be a lot of political resistance to this idea, but I think there's finally a thirst for this. And mind you, this is not just about cryptocurrency. This is about all fintechs, right? So if you're starting any fintech, you have to deal with this state-by-state money transmission licensing issue.
And by the way, in fairness to the states, to a certain extent, the states are trying to rationalize their own processes.
Mm-hmm.
A number of the states now use a common application, it's almost like a common college application, NMLS, which allows you to apply with a single basic application form. And then very, very recently, literally within the last couple of weeks, I think 7 of the states basically agreed to recognize the acceptance of any one of those states' core application materials. The other 6 states would recognize it. So there's some movement on their own, but it's a very, very
it's nipping at the edge.
Yeah, it's just beginning. I know we got a few minutes for questions, so I'd like to take a few questions. I know we have Slido. Okay, I always thought Slido was a men's bathing suit, but go ahead, ask us some questions.
So someone would like to know.
We have no microphone. All right.
Nor do we have 2 turntables.
All right. No, not working. All right. You know what? Why don't we just raise our hands the old-fashioned way? Go ahead.
Robert Schroeder was an international investor. There is a piece of legislation going through Congress right now. Still being debated.
No, it's not.
Significantly reduce the regulatory process with Dodd-Frank legislation and others. What would be the implications? Are there any for cryptocurrencies, etc.?
Yeah, I mean, I'm not aware that that initiative is addressing the space necessarily. The goal of that legislation is mostly to roll back some provisions of existing Dodd-Frank as opposed to trying to propose new regulatory initiatives. So I'm not sure necessarily that would be touched there. I think that to the extent that there is going to be legislation in this space, it would be entirely new legislation. But again, to Brian's point, I'm not sure there's enough agreement as to what's being regulated yet. I'm not sure there's enough understanding as to what necessarily are the objectives of the legislation and what should be the outcome. So, I am personally not aware. I don't know, Jerry, whether you're aware of anything in the rollback legislation that would touch the space.
No, I think the only legislation right now in Congress that touches on these issues really is a tax bill.
Right.
That would create a de minimis exemption for personal cryptocurrency transactions. There is a anti-money laundering bill that would essentially codify what FinCEN has done, basically, in broad strokes. And there is a bill that would create a commission to study terrorist and illicit uses of the technology.
There were early versions of the rollback bill, and I don't know if it's still in there, that instructed or directed the SEC and the CFTC to work together, particularly on Dodd-Frank swaps initiatives. A creative leadership at either agency could take that to enhance their ability to harmonize, but I'm not even sure it made it in the bill.
Other questions? Oh, you got it now? Okay, go. Shoot.
So it appears that the attendees are very interested in what's happened in New York State with the BIT license. And they want to know, how has it impacted companies who may choose to not serve New York customers? What things can market participants learn moving forward?
I'm happy to try that. I actually talked to those guys this morning. So there's still only 6 entities that have the equivalent of a BIT license. New York State actually, says that if you engage in virtual currency business from New York or to New York persons, you require a BIT license, and virtual currency business is very basically defined as engaging in money transmitter type businesses or custody in the most broad brush strokes. Today, there are 2 firms that have what they call limited purpose trust company authority, which embraces the BIT license, and then there are 4 entities that have independently BIT licenses. So the fact that there are a number of exchanges in the United States, crypto exchanges, there are a number of folks in the space that are doing this business and don't have this, sort of tell you that the conditions are quite onerous. At an absolute minimum, to get a BIT license, you've got to have 4 types of manuals that most entities may not have in this space. You need AML policies. Well, that's pretty common because you need that for FinCEN. You need a cybersecurity manual. You need a business continuity manual. And New York State, as of about 4 or 5 weeks ago, as part of a BIT license requirement, now requires that you actually have surveillance ability. So they want you to surveil transactions to make sure there's no market abuse. This is in addition to lots of other qualifications. So firms have purposely decided not to do business from New York or with New York persons to basically not deal with this. I will tell you my own experience with New York State regulators is that they really want to try to accommodate people to try to get this thing done, but they do have certain minimum expectations of what needs to be done. Jerry, I don't know what your experience is.
No, I think that's generally right. I think that unfortunately New York attempted to be the first out of the gate with to address the cryptocurrency question in the money transmitter context. I think they had a real opportunity to get it right. Unfortunately, what they ended up with, and the rationale for doing a BIT license, which is a technology-specific license, which is not something typically that you do, was that the existing money transmission licensing was too old and antiquated and really wasn't a fit. And what they ended up with in the BIT license is essentially, and you can compare the statute, it's not even a statute, it's a regulation, you compare them, it is a money transmission license with additional regulations that are more onerous for, it's basically, if you're engaged in the same business as everybody else, but you're using this technology, you have these extra onerous requirements. What I'm happy to say is that the Uniform Law Commission has developed a model act for state regulation of cryptocurrencies that is a model for other states. It's focused on custody. It addresses the cybersecurity concerns. It addresses the solvency concerns, but it does so in a way, I think, that is much more rational.
We are
The
now.
sorry,
go
the
ahead. Do it.
best part about that is that Hawaii's actually proposed to adopt it.
Yes.
So if anybody's looking to learn more,
We've been
Hawaii
lobbying
has
to
one of the
testify at the legislature.
Right. Everybody's volunteering to testify on that one. Well, thank you very much, panelists, and thank you very much for the audience for being attentive and asking the few questions you did. Thank you. If you have questions later on, we'll be circulating around.
Thank you very much for a very informative panel. And now, well, the moment you've been waiting for, not the reception, the other moment you've been waiting for, our fireside chat with Commissioner Benham of the CFTC. So, we're running a little bit, we want to make certain that we're mindful of everyone's time. So I'll briefly say that he was nominated by President Trump as a commissioner of the United Commodity Futures Trading Commission. He was unanimously confirmed by the Senate, which may have been the last time something like that happened. And prior to that, he worked as senior counsel for U.S. Senator Debbie Stabenow of Michigan. So please join me in welcoming Commissioner Rostin Benham. And we will be having questions via Slido, so feel free to submit those. And if I'm impressed by your question, maybe I'll read it. So, Commissioner Benham,
first, thanks for hosting me to IFM and Mercatus. It's good to see a lot of familiar faces here, so happy to be here and share thoughts on a pretty interesting issue.
And
that was a pretty heady panel beforehand, so not sure if we're going to meet that standard.
Well, you know what? Look, we're here to ease people into the reception. So don't worry about it. And thank you for coming. We really do appreciate it. So the first question is, there's been a lot of discussion about crypto assets, cryptocurrencies, whatever. And the fact that we struggle with the second part of the word tells us the diversity of uses. And we've had a lot of agencies get involved, and yet the CFTC seems to be the one that's really just taken this issue on board and run with it in a big way. And I'm just curious, why? Why is the CFTC of all these agencies, why have they adopted this mindset, which is arguably sort of more friendly, more pro-innovation than some of the other agencies?
So first off, I think Brian mentioned this earlier, views are my own and don't represent the commission's or anyone at the CFTC. Great question, and there certainly is a lot of interest at the CFTC about this issue. There has been for several years, although I think the price of some of the assets in 2017 gathered a lot of general interest from folks in the States and across the world because of the price of Bitcoin and the other coins. We've been at this since about 2014 or 2015. And as much, again, as there is interest from staff, it really comes down to the statutory mandate. As this would, I think Gary mentioned this earlier, the definition of commodity is very broad. It includes the more traditional commodities that we think of, whether it's oil and natural gas or corn and wheat, but also these rights, services, and interests, which was pointed out earlier in 1975, was expanded. So if there is a contract for future delivery on pretty much anything, it's going to come within our jurisdiction. The first issues came up with swaps, and then obviously in the second half of last year, there were 2 futures contracts listed, which really kind of gathered the momentum for us to have jurisdiction. So we've been focused on it for quite some time, but certainly because of the statutory mandate and the mission that we have to fulfill.
So let's pick up on that for a second, because one of the themes that's come through in this conference and in a lot of the discussion is that these assets can sort of cut across a bunch of different regulatory regimes. They can be conceived of somewhat differently. So, depending on what what frame of reference you're looking at and can be subject to different rule sets.
Sure.
So from your point of view, I mean, do you think the definitions here make sense, or are we dealing with a bunch of definitions that were sort of written prior to this and fit uncomfortably with the nature of these assets?
So on the security side, and again, this was mentioned earlier about the Howey Test, and if you think about ICOs and the idea of, you know, putting money through a contract into an enterprise with the expectation of profit, based on what I've read and heard, and, you know, compliments to Chairman Clayton and the rest of the SEC for all the work they've been doing, you know, that seems to fit within the definition of a security. On the commodity side, like I pointed out earlier, the definition is so broad, and again, if you're going to have a contract with future delivery, it's going to come within our jurisdiction. To your point, these assets are so novel, so new, that perhaps we need to rethink what we're covering, what the jurisdiction is, and what the statute says. And the conversation about Congress getting involved, and more importantly, a sort of cross-harmonization among all regulators, not just the SEC and CFTC, but if you think about Treasury, FinCEN, the rest of the prudential regulators, there needs to be a broader conversation about what the policy direction is going to be, and who is going to have jurisdiction over what element of it. Whether it is ICOs, whether it's derivatives contracts, whether it's payment systems, whether it's ledger. I mean, there's so many elements of fintech and coins and whatnot that we have to, I think, wrap our head around what path is going to be sort of viewed as the policy direction, and then start to parse out who has jurisdiction, and if there are any vacuums or, you know, shortcomings, then we need to create statutory language to authorize that.
Sure. So to pull on that thread just a little bit more, I mean, do you think that the CFTC, if you were advising Congress and the President on this, speaking in your own capacity, you know, do you think the CFTC needs more authority? Do you think it might have too much authority in this area, such that this is an area where you if you could sort of cut that off, assign to somebody else, and CFTC could focus on more of its, you know, its core area?
Yeah. No, I think so. The biggest concern I feel in this space right now, and we have, again, jurisdiction over the derivatives contracts. We have jurisdiction over fraud and manipulations in the underlying reference markets. So what that leaves empty right now is the cash market exchanges, which are not being regulated. So with respect to the 2 Bitcoin futures contracts, there are reference contracts that we can oversee if there's fraud or manipulation. But that leaves a very broad swath of cash markets that are not regulated. There was sort of suggestions, I think, a few months ago, and I think this gets to your question, is do we need to expand our jurisdiction so that there is oversight or regulation over these exchanges? And it was mentioned earlier about the state money transfers, and really the states being the sole and primary regulator. If you think about the mission and the purpose of the CFTC, if we were to expand our jurisdiction, it would really change the whole face and purpose of the CFTC. So I don't think we need more jurisdiction. I think the current statute and the current definition of commodity is broad enough. And with respect to derivatives contracts, futures, options, and swaps, we have the jurisdiction that we need to oversee the market that we have traditionally overseen for many years. The larger question becomes what other agencies need to be involved, and what policy direction are we going to take as a country so that we have each of the relevant regulators overseeing the right part of this sort of organization.
And so do you think that for that conversation, or at least for a good approximation of that conversation, think this is something that the regulators could do on their own, or does Congress need to come in here and step in and draw some clearer lines?
I don't think Congress needs to step in quite yet. Thinking about my days on the Hill, you know, Congress needs to rely on the administration and the experts within the administration to be able to sort of make recommendations or advice on how specifically to set policy. Legislation should, you know, ideally not be too specific. It should be broad and setting forth broader policy that the administration would implement. In this case, things are so new. I think there's still uncertainty about the policy direction, that there needs to be more hearings and more discussion, both in Congress and I would say within the administration, before we can propose potentially any legislation. And I'm not suggesting there needs to be legislation, but given the sort of dynamics of what's going on and some of the sort of vacuums that exist in the regulatory space, perhaps there is. one of the biggest concerns, which I mentioned earlier, with the cash markets and the idea of state money transfers. And this was mentioned earlier, the fact that we have 50 states potentially overseeing the cash markets for these permits. That seems like a pretty ripe area where the federal government could step in and say, hey, we need a little bit of federal preemption so that we can have one system and one size fits all for everything. I've mentioned this a few times, most recently I think in March, that when I think about the federal financial regulators, and I don't think necessarily if you were to sort of redraw the map today, you would do the same with respect to the prudentials and the independent agencies and Treasury. But certainly FSOC seems to be one of the best vehicles and venues to start to have this conversation. I definitely recognize Secretary Mnuchin. I think he started a working group in January about cryptocurrencies. The White House released a paper on sort of a fintech framework in January as well, which are all great steps, sort of forward-thinking ideas. But given the pace with which innovation is moving, and I think the desire from the market on a regulatory side, there needs to be more proactive movement from a body like FSOC to convene, to have these public hearings, to start to talk about these issues at a more granular level, and then essentially either make recommendations or start to come up with advice about what agencies need to be doing what, how we're going to be thinking about fintech generally from a coin standpoint, from payment system standpoint, and then ultimately, if there needs to be legislation, make any potential recommendations to Congress.
Okay. So transitioning from sort of the inside the Beltway DC stuff to out in the world, from your point of view, and I'll specifically talk about the centralized ledgers as opposed to centralized ones. Are you seeing? I mean, how are you seeing these things being deployed Are you seeing these things being deployed, or do you see any potential for these things in the futures markets beyond just being the subject of a contract?
Right. So I think to think about that, it's a little bit of an evolution and a spectrum, because there have been reports and there's actual use cases of private ledgers existing. I think Louis Dreyfus, which is one of the larger ag grain handlers and traders, set up a private ledger to start to process grain handling. And if you think about it from a tracking standpoint, from a line of credit standpoint, there's so many, and from a payments and processing standpoint, there's so many benefits to a private ledger that can create so many efficiencies and synergies across the sort of spectrum. To transfer that to a public ledger, I think we're all very confident and optimistic about the potential in a public ledger, but there's certainly a lot of risks that I think currently the systems, the ideas, the sort of boundaries that we've set up, if at all, are not quite clear enough for a public ledger system to sort of incent business to go there quite yet. I think the ideas are there, but in theory, we can think about what Louis Dreyfus is doing to be on a public ledger, or we can think about exchanges to be on a public ledger, and what goes on in terms of trading futures and derivatives. But I think it's quite early to be really thinking about those ideas. I think the evolution should happen from the private ledger and then eventually potentially get to the public ledger if it's ripe and if there are enough system safeguards and sort of protections in place.
Yep. I mean, so you mentioned some of the risks. I mean, what do you see as the most acute risks of going from a private ledger to the public model?
So fraud and manipulation, op risks, operational risks, and then cyber risks. Those are pretty prominent in this space. This is what this sort of space is made up of. And I don't think we are quite there in terms of understanding the infrastructure, the piping, to truly appreciate what could happen, but then more importantly, set up systems that are safe enough where we could launch, execute, without having an overarching fear that one of these risks might overcome the system as a whole. So I do think we need to be a little bit cautious and sort of more reserved in the movement towards having these public ledgers while examining these sort of risks that exist. And I mean, thinking about cyber risks, that's sort of transcending our world these days with the way technology is moving, and it certainly is going to be a huge part of this.
Sure. So now one thing we sort of alluded to earlier is the fact that the CFTC has been very very engaged, right? Rather than just saying, okay, look, here's some guidance, and try not to end up in jail.
Yeah.
There's been a lot of engagement. How's that going? Like, from your perspective, how is engagement with industry going in terms of working on these issues?
So I will say, and Brian mentioned this, I do want to commend our chairman, Chris Giancarlo, who's been very forward-thinking on these issues, as you all know, for many years now, creating Lab CFTC and wanting to engage with stakeholders. I've certainly been a part of that conversation since I was sworn in, and a lot of folks have come in. And the bottom line is they are hungry for certainty. They are hungry for clarity. I think they want to operate their businesses. They want to take investments. They want to move forward, and they want to stay in the States. And there's I think Angela pointed out this earlier. There's the friction between supporting innovation, wanting to keep business in the States because it will move abroad and overseas very quickly, but also wanting to create fair lines so that we have a safe system where customers are protected ultimately, but also that there's internal infrastructure that is resilient enough to sort of combat some of those risks I pointed out. So it's interesting in a sort of situation where traditionally you'd have stakeholders and market participants not terribly interested in regulations, not terribly interested in new laws, but I think we're in a situation now where there's so much uncertainty about not only what the rules of the road are, but what direction we're going to take. I keep going back to that sort of policy direction that market participants and stakeholders and the innovators ultimately are just looking for some sort of a certainty about what DC could potentially do so that they can move forward with their businesses.
So we have a lot of industry in the room.
Yep.
We have industry who will be watching or listening in the future. So here's your chance here's another chance to speak with them, shall we say. What do you, in terms of industry engagement, what's industry doing well, and what does industry need to improve on?
So the one caveat I will say to that is, how do we define industry? And I don't mean that in the we know what industry is, the stakeholders, the market participants, but this is a broad constituency, and there are many good actors, but there are many bad actors, and I think that's where the risk lies. Is all the individuals, all the companies that are coming to DC that are engaging with either council or regulators or the Hill want to find direction, want to find positive discourse in what the policy will be on these issues. And for the most part, these individuals, these entities are the folks that are looking for a positive movement towards a regulatory framework. Obviously, there have been a lot of enforcement actions. There's been a lot of theft and fraud and manipulation in this space for several years. The CFTC alone, I think since 2014, has had 7 enforcement actions in the crypto space. So I think the number one goal is to engage as many people as we can in this space. There are always going to be outliers. There is in every industry where you're going to have folks committing fraud or manipulation, but we need to have more of a holistic conversation, as inclusive as possible with everyone, so that folks understand that we want a healthy market. This is a transformational technology, and it can benefit everyone. And we want folks to be engaged so that we can set the rules of the road in a fair way, in a transparent way, so that we, again, can incentivize innovation, but also make sure that folks know that we have the safest, best market in the world. The concerns I have and what not to do is there's a lot of hype around this, right? Mm-hmm. And again, going back to December and November of last year when Bitcoin was nearing $20,000, you have retail investors getting involved. I'm sure many in this room have experienced the same thing I did. I have friends I'm home for the holidays, and someone's like, oh, I bought Bitcoin or Litecoin or Ether, and I'm like, why are you doing that? You should not even come close to that. Or I get in an Uber ride to go to the train station, and I get asked about Uber or about Bitcoin, and it is transformational in the sense that everyone is engaged because it's fast money and the returns could be quick. So I think we need to lower the temperature a little bit, be thoughtful about what we're sort of engaging in, and again, recognizing the fact that this is potentially transformational technology across many spectrums of commerce. And if we take it slow and steady and move thoughtfully, we can really set up an amazing infrastructure for an economy that will maintain what we are right now is at the best in the world.
Okay. So beyond sort of industry, I mean, I work in the nonprofit sector because, the idea of making a profit scares me. Just kidding. But
we need people like that. Yeah.
Yes. So the question is, so what, I guess, what are you seeing, and what can the nonprofit sector, what can civil society, what are you seeing in terms of their engagement, and what would you like to be seeing?
That's an interesting question. You think about the groups in DC, yourself included.
We're on the other side of the river.
On the other side of the river, that's fair enough. What you're doing today, this is a perfect example, right? Whether it's the folks in the room or the broadcast that people will watch in the future, is getting folks engaged in understanding what we're doing and why we're doing it. The players, Ryan talked a lot about jurisdictional boundaries between the SEC and the CFTC, probably went over a lot of heads, but those are the types of conversations which I think will incentivize and instigate more thought-provoking ideas and forward-thinking ideas so that across the board we can have a better conversation and better discourse about what we're getting involved in. NGOs and non-for-profits have historically and will continue to play a huge role, I think, in our government and our democracy. The push and pull of ideas and the friction of ideas is the reason we come up, I think, in my mind, with the best products in the end. And the more people we get engaged, whether it's academics, regulators, stakeholders, market participants, not-for-profits, more ideas is the better, because in the end we're going to get, I think, the best results.
I'd like to take a brief moment to remind the audience that you can use Slido if you have a question for the commissioner. Now, I still have some questions for the commissioner. Going back to the regulator issue for a second, we talked about sort of domestic coordination. What about international coordination?
Right.
How is that going? And are there issues or cases where it's going particularly well or particularly poorly, and what could be improved?
So again, playing off of the FSOC idea, this is the G20, right? Or this is the international organizations, whether it's IOSCO, FSB. We need to have more of these conversations. There's the challenge of sort of a race to the bottom on the regulatory standpoint. I think folks, as was demonstrated earlier, are very engaged. Countries are engaged. They want the business. They want to incentivize technology and innovation. So it's important, I think, for sort of G20 countries to get together and to move forward. Again, going back to that balance of supporting innovation, creating this sandbox, but not inhibiting it, it's a tough balance to strike, but we do have to set policies and frameworks in place, because if we don't, and we kind of err on the side of, if we set something in too quickly, we're going to stifle innovation, I think there are more risks there, right? Because if we don't set the policies and the rules of the road now, in my mind, that's when you might have larger risks of, again, the fraud or the theft, which takes us backwards, right? And we want to have a positive message on fintech. We want to have a positive message on all of the technologies that I think can create efficiencies across the board. And if we don't have those rules of road set up, we're going to sort of create that vacuum where you're going to have bad actors engaged and really send a negative message for the technology. And I think that in the end will not be helpful for anything.
Okay. So if I grant you a magic wand, and you can use it to have Congress pass one law relevant to this, what would it be?
Can I sell the wand?
You can sell a futures contract on the wand. I don't have it with me now.
These days, that wand would be worth a lot of money. I think going back to the cash markets and the idea of state regulators and money transfers, that is the one thing that worries me the most. I think if you think about futures markets or securities markets, you want to buy a share of a blue chip company, go online, call your broker, you buy a share of, there's transparency at every element. There's also safeguards at every element to make sure that you're a capable investor and that you have the funds to be able to invest, and you're not creating too many risks. Going back to the example of my friend or the Uber driver, you don't know who is participating in this market, and then when you participate, you don't know what you're participating in. There's obviously a lot of trust, but we've had, whether it's Mt. Gox, I think, or some of the other exchanges have had these massive cases of theft. You don't know what is exactly the market. It's just completely opaque. So to your question, my wand would request, I think, some level of harmonization among the states, which might create or require preemption so that we don't have this patchwork of state transfer laws. And I want to mention, I used to work for the New Jersey Attorney General's office, so I have all of the respect for NASA and state regulators. They do great work, but there are certain circumstances, especially in this case, where interstate commerce and that becomes kind of ambiguous, right? We need obviously everything is global, and we need a single law and to manage and oversee these issues, and especially with the cash exchanges. I just think that is really where the risk lies these days.
Okay. So, final two questions. We're going to go negative, then we're going to go positive.
Great. That's good.
All right. What is it about this space?
I love that no one has questions in the audience, too. Everyone wants to get to the break or the cocktails.
You know what? You got to know your audience.
Yeah. There you go. It's been a long day.
Yeah.
That's good.
So, okay, negative question is, about the space, what keeps you up at night? To the extent anything does. I mean, I won't begrudge you your sleep, but...
I mean, I'll keep this quick. It's the cash markets.
Right.
And I mean, thinking about the 2 Bitcoin futures contracts that we have over at the CFTC, again, we have fraud and manipulation jurisdiction over the underlying, but there are so many exchanges. There's a lot of arbitrage going on. Obviously, I think that's shrunk over time, but there's too much out there. There's too many retail investors who are not sophisticated and are, you're going to start seeing, I think, as thinking about post 20,000 Bitcoin, as prices of the coins have come down, and you start to see these lawsuits popping up. And I think that will be a reoccurring theme in the next couple months. And that's what sort of keeps me up at night, is the complete vacuum of regulation over the cash markets.
Okay. Now to go positive.
Yes.
What about this space excites you the most?
So going back to what I think we originally talked about, and I'm going to harken back on some of my Senate Ag days, thinking about what capabilities we have. So on the CFTC side, and then I'll flip to the Ag side. CFTC side, I think one of the coolest things that could happen from a regulator standpoint is thinking about a ledger, right? And collecting data and monitoring systems and markets, right? We could be a node on a ledger, and it could be a private ledger of market participants, but it could create so many efficiencies across the market, not only for us, it could standardize data. There's so many possibilities that I think will make our jobs easier, market participants' jobs easier, and ultimately the markets more efficient and better. I've heard examples which, going back to the Louis Dreyfus, thinking about food safety or transportation of food, and being able to track food from the farm to the sort of table, to use that cliche analogy, but being able to use a ledger and this technology to see food move on the value chain is a neat prospect, I think, for the consumer, but also for the producer, because there, again, so many efficiencies created that will benefit everyone, not only from a sort of know where the product is coming from, but also from a safety perspective. So, and I think that probably crosses so many different spectrums and fields that I don't think about necessarily, but whether it's financial services or ag, I think there's so many different benefits that can be taken away from this technology.
Well, that's exciting. And
it is.
We should note, a bit ironic that something that was born out of initially out of the idea of pseudonymity and movement is now the great thing is law enforcement has this giant ledger.
Yes.
So,
yes.
But we take the advantages where we can find them.
Yes.
Anyway, thank you very much.
My pleasure.
This has been a wonderful conversation.
Yeah.
And we're at 5:30 on the dot, which means that people can go.
All right.
So anyway,
Thank you.
please join
I
me
appreciate it.
in thanking Commissioner Benham for a great conversation.